9 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and this is Yahoo Finance's flagship show, The Morning Brief.
Stock futures on track to open lower this morning after the first two Magnificent Seven members reported mixed results, sending shares lower for Tesla and Alphabet. So let's get to it. The three things you need to know for this Wednesday morning. Yahoo Finance's Praz Subramanian, Dan Howley, and Jared Blickery have more.
Tesla's second quarter earnings underwhelmed investors. Shares of the EV maker falling after reporting mixed results and posting its fourth straight quarter of disappointing profits. The company said its growth rate in 2024 will be notably lower than what it achieved recently, as the wait for more cheaper EVs and a boost in sales may only come next year. As usual, Musk doubled down on robotaxis and self-driving on the analyst call, claiming Tesla's long-term value lies in autonomy.
I recommend anyone who doesn't believe that Tesla will solve vehicle autonomy should not hold Tesla stock. They should sell their Tesla stock.
We're also watching shares of Alphabet fall in pre-market trading. Investors are overlooking the tech giant's better-than-expected earnings after YouTube ad revenue came in below expectations. The company also warned that capital expenses would remain relatively high for the year. In the second quarter alone, Alphabet spent over $13 billion, above estimates of just over $12 billion. However, the company did see some bright spots. Alphabet's cloud business continued to pick up steam, topping the $1 billion mark in operating profit for the first time. Alphabet shares are up 30% year to date.
And a demand for luxury might be stalling. Shares of LVMH are falling after second quarter sales fell 1% from a year ago. LVMH is struggling to win back Chinese consumers as more shoppers pull back on spending. The results driving fears that the company is falling victim to a broader slowdown in the luxury goods market following a surge in demand in the aftermath of the pandemic.
Our top story today, two of those Magnificent Seven members, Tesla and Alphabet, pushing Nasdaq futures lower after investors were not wholly satisfied with those earnings reports. We've got team coverage of those results. Yahoo Finance's Praz Subramanian and Dan Howley are with us with more. Praz, let's start with you. Shares of Tesla moving to the downside this morning after that mixed report. What are your top takeaways?
Well, first off, we finally have a date for the robotaxi reveal. Musk claiming on the call that Tesla's robotaxi will be shown on October 10th. Good news, but the company says it'll use the unboxed assembly process, which could take years to develop. Next, affordable EVs are coming in 2025. Tesla says it's targeting the first half of 2025 for production, so not exactly early 2025 as they said before. But the big question is, when are we going to see these products? Analysts say Tesla needs these cheaper EVs because margins are getting crushed by price cuts. Finally, a subdued Elon Musk. Musk was a little low energy on the call, not exactly reassuring for investors. He once again said in a subdued tone that autonomy is the future of the company, but claiming he's not concerned about regulatory self-driving scrutiny, which seems very unrealistic. Then there's the whole discussion about AI and Dojo supercomputers. Musk admitting that Dojo is seemingly far behind NVIDIA's latest chips. Then once again, Musk got dragged into the whole diverting of chips from Tesla to XAI. Analysts talking about that on the call bring up yet another distraction for the seemingly wary CEO.
All right, Praz, last to digest there. Howley, let me toss it over to you because another name that we're keeping a close eye on is Alphabet. We've got shares off just about 4%. What stuck out to you in this report?
Yeah, there are a few things. First up, addressing why shares are down this morning, despite the company beating on most metrics. YouTube ad revenue fell short of estimates, which was a surprise to many. The segment brought in $8.66 billion versus $8.95 billion that was expected. And YouTube is facing increasing competition from social media platforms as well as Netflix. Second, Alphabet and other tech giants are pouring money into AI. In the second quarter, Alphabet spent $2.2 billion building AI models across its DeepMind and Google research organizations. That's up from $1.1 billion last year. And Wall Street is confronting the question of when this AI spend is actually going to generate revenue. And then third, a positive for the company, Alphabet's cloud business is gaining steam, topping the $1 billion mark for operating profit for the first time. Google saw cloud revenue and operating income both beating analyst expectations.
All right, Praz and Dan Howley, thanks so much for breaking that down for us here. Let's dive into the report that we're just getting out here from Tesla. It was out after the bell last night. We're seeing the reaction play out here ahead of the opening bell this morning. You've got shares off just about 8%. And Tesla reporting mixed results for the second quarter, posting its fourth straight quarter of disappointing profits. For a deeper dive into those results, let's bring in Jeffrey Osborne. He's TD Cowen's managing director. Jeffrey, it's great to have you here. So first, I'm curious to get your reaction to this report, because clearly the street taking some issue with the results that we got out last night. Do you think the pullback that we're seeing this morning, is that justified?
I do think it's warranted, and thanks for having me on. The biggest disappointment in my mind was really the gross margins on the core auto business. 80% of the call was discussed. Elon was discussing things that really don't exist at this point. But if you just really get back to the nuts and bolts of the company, the auto business is really struggling. It's a tired Model 3 and Y lineup. Really need to see a reinvigoration, as your colleague was talking about, of the portfolio next year. That got pushed to the second half of the year. So I think the pullback is warranted. We're going to be in an information vacuum until October 10th. We have that autonomy day, and then we get more details about the new low-cost vehicle that's certainly needed in this type of economic environment.
So Jeffrey, are investors almost in a holding pattern then at this point, do you think?
I think they are in a holding pattern. You really have to just put yourself in the lens of an institutional investor. You've got the Magnificent Seven. People can allocate the capital between those. And if Tesla's in an information vacuum for the next quarter or two, people play AI in other ways, whether it's Google, NVIDIA, et cetera. So certainly other opportunities here. But what typically excites investors is when there's reality around new things for Tesla. And right now, what was expected to be reality next month in August got pushed out.
Well, on that earnings call, we also got some insight into how Elon Musk is thinking about potential policies to come that could impact Tesla. I want to listen to what he had to say about any potential rollback of the IRA.
There would be like some impact, but I think it would be devastating for our competitors, but and it would hurt Tesla slightly.
So basically arguing it would be worse news for our competitors than it would be for Tesla. As a Tesla shareholder, from a financial perspective rather, for shareholders, would a policy like that hurt Tesla less than competitors? And how should those shareholders be reading that?
Yeah, I mean, certainly Tesla's been at the EV case for a longer period than pretty much any other car maker. So other car makers, sort of by definition, certainly are benefiting more from the tax credit than say, Tesla's typical buyer. I would say it's completely contradictory to what Elon's mission was to start. He wanted EVs to proliferate for all, and even talked about sharing the technology, licensing battery and safety technology to other OEMs. And so now he seems to have taken a different tactic as it relates to boxing out the competition. But I do think it'll hurt everybody. So I'm not a believer in just one side of the ledger gets hurt, but certainly any new entrant that is subscale, both in battery manufacturing and car manufacturing, would benefit from these types of credits. Given the income limitations that have been put on that with the IRA, you're essentially forced to lease cars. That's not for everybody. So it is a subsegment of EV buyers that benefit from the credit, just due to the income limitations that have been put on the $7,500 tax credit, though.
So from a policy perspective, who is better for Tesla shareholders, Kamala or Trump?
Yeah, I personally think that the Democrats win would be better for any type of EV and energy transition company. There's just a lot more subsidization and an easier transition path. I think there would be a lot of confusion in the market if the 2027 EPA targets were rolled back under a Trump administration. There certainly wouldn't be a direction of travel or marching orders, so to speak, for the industry. And so some OEMs might take a more leisurely pace in getting there relative to, say, the European market and China with its new energy vehicle policy credits. Those are similar, if not larger sized markets. And so if the U.S. takes a step back as it relates to emission standards under a Republican administration, it's going to hurt the OEMs that have a variety of vehicles that they can sell, because it just limits the scale that they have with EVs, and it'll force them to come up with options for both the European market and China, which are still forcing automakers to go down this path.
Jeffrey, let's talk a little bit more about what could be a catalyst here for the stock going forward. There's lots of focus on the cheaper vehicle. Now the thought is that we're not going to see that till 2025. And then the thought of the robo-taxi. And I bring that up because Musk was saying it's going to start with this prototype. He expects to roll it out by possibly here by the end of the year. How realistic do you think those two timelines are? And I guess if we don't see a cheaper vehicle in the first half of next year, how big of an overhang, how big of a drag could that then ultimately be on Tesla stock?
Yeah, it's a great question. I think the key question in my mind is the cheaper vehicle, likely, hopefully gets shown on October 10th, or there's some details about it. They made reference over the past 6 months that will not be a new platform or a new vehicle, what was referred to as the Model 2 or next-gen vehicle platform, likely to originally be built in Mexico. They backed off the Mexico facility on the call last night. My mind is it's really just an upgrade, if you will, to the Model 3 and the Y. Historically, car makers would do this, throw on spoilers, bigger wheels, fenders, et cetera, turbochargers to invigorate demand. That's a little harder to do in an EV world, especially where competition is accelerating incredibly fast, against Tesla. And so I'm personally not a believer that if it is just a Model 3 and Y refresh and sort of stripping it down or decontenting it, that'll lead to an invigoration of growth in the second half of 25. They were clear it would be on existing platforms or factories, which are today underutilized and suffering from a margin perspective. But the key question is, could a refresh of the platforms that are existing stimulate better margins or higher price? I'm pretty skeptical on that. As it relates to the autonomy side, which is really what the purpose of the October 10th event, I think the key question is the event around a robo-taxi service, which is what we were led to believe, and then will it be a car without a steering wheel and gas pedals and brake pedals? That essentially, everything is done by computers. That's sort of the definition of robo-taxis, obviously. But GM just backed off of that yesterday morning. And I'm not sure that the insurance industry, the consumer world, let alone regulatory policy, is ready for that. That last point on that front is, this has been going on for 5 years, where Tesla has been leaning into autonomy and robo-taxis. They had a whole event on 2019 that they raised a bunch of capital afterwards on that. And here we are 5 years later with very little disclosure on what progress they're making, other than just beta software releases and sort of the incremental progress that's been made, now talking about 12.5 on the call. But what we really need to see is the number of interventions that drivers have per mile or per minute, ideally both, to get a sense of what is the technical progress. There's a very controversial approach, last point I wanted to make, that Tesla has relative to peers, where they're only using a camera and the AI computers to solve this problem. Most other car companies around the world are using a suite of sensors coupled with the software. And so, given they've been promising this for 5 years, it's a bit hard to imagine in my mind that a camera-only solution will truly get the company there with the existing fleet of cars, hence why they probably need a purpose-built vehicle that we'll get more details on October 10th about.
Good reminder that investors should be taking a look at the product announcements as well, Jeffrey. Thank you so much for joining us. We appreciate it. That was Jeffrey Osborne, TD Cowen Managing Director and Senior Research Analyst. Moving on to Alphabet, shares moving lower this morning, down about 4% here after YouTube ad revenue came in below expectations. The tech giant continuing to double down on AI investing, with capex spending over $13 billion in the quarter. That was above estimates of just over $12 billion, and that was another thing investors were disappointed with in the earnings print. CEO Sundar Pichai explaining Alphabet's investments on the company earnings call.
I think the one way I think about it is when you go through a curve like this, the risk of underinvesting is dramatically greater than the risk of overinvesting for us here.
For more on these results, we've got Brad Erickson, RBC Capital Markets Internet Analyst, joining us now on the phone. Brad, thank you for making the time this morning. We just heard Sundar Pichai's commentary on underinvesting being more of a risk than overinvesting. Is that true for shareholders?
Yeah, thanks for having me. I would say generally yes. This company is generating a ton of cash, right? 60, 70, 80 billion in general over the next few years, probably. There is plenty of room there. Certainly they have the balance sheet and that cash flow to fund this. There is always going to be some concern, and this is just kind of more of a near-term thing, I would say, is that is the company's sort of structural return on invested capital declining? Yeah, I think you can probably make that argument. But to his point, if this opportunity does turn out to be as big as many think over time, these investments will have proven correct.
Brad, from your modeling, what do you think those opportunity or that monetization opportunity looks like, and how big of a catalyst could this ultimately be for the company, for the stock in the future?
Yeah, sure. So, I think maybe just to go to the numbers, because it's a very complex topic qualitatively. The search business, we think, is probably adding something on the order of close to $20 billion a year. And then the cloud business is right now is on pace to kind of add about $10 billion a year. So you add that up, $30 billion. This year, the company is expected to spend about 50 billion, not quite 50 billion of capex. And so I think what investors are trying to sort of take a view on and figure out is what portion of that 30 billion of incremental revenue is attributable to AI versus other stuff. And I think at this point, what we're hearing from the company, and this is our view, is that all of it should essentially be attributable, because obviously we know the full amount of the capex. And so I think if you look at those numbers over time and they continue to stack on that type of growth, I do think the investment case for what they're investing right now will make sense.
I'm curious about, I want to focus on the capex piece a little bit more, Brad, because as you mentioned, they did spend $1 million more than what investors had anticipated. How much longer are investors going to be willing to tolerate that amount of capex, given that, as you mentioned, it is a little bit hard to suss out how much of their revenue is coming from the AI that is leading to a lot of those increases in expenditures?
Yeah, so I think I take a little bit of a maybe alternative view to some on the capex last night. I would actually argue that, they missed by $1 billion, as you said. That is true. However, the CFO did reiterate kind of the run rate commentary through the end of the year. If you recall last year, they basically, for 2 quarters in a row, capex commentary got worse and worse. And it kind of suggested that we call it, the ground was kind of moving underneath them. There's all this AI spend. We all know about the GPU situation with NVIDIA. And it just suggested they didn't quite understand what was going on or have a good sense of visibility. I think based on their commentary last night, I actually view them as now having a good sense of visibility. And so what that means is, kind of from a second derivative perspective, is it's not getting marginally worse. That's generally a good thing for stocks.
Brad, when it comes to where Google is, I think they were initially viewed as maybe having a head start within the AI race. They were making that case for a while. Now there's questions about whether or not they can compete with Microsoft, with OpenAI, and exactly where they stand. What's your assessment? Just should investors be worried about maybe the lead that Microsoft, OpenAI have in the space right now? Or is Google going neck and neck with Microsoft? How suss that out for us, exactly where things stand within this AI race?
Yeah, sure. So there's kind of 2 points in there. Basically, one is there's an AI concern and risk around the search business, right? And 2 is kind of how well can they participate in the cloud part of it, right? So let's take those one by one. On the search business, they beat estimates by $1 billion, which was not quite 2%. There's concerns of macro weakness. There's other companies talking about a softening consumer. Google is clearly not seeing it and easily sort of rebutting that bear case. So that's search. On the cloud side, they said last night almost the majority of their top 100 customers are using generative AI tools. It's a multi-billion-dollar business, suggesting it's upwards of, kind of call it mid-single digits of total cloud revenue. So I do think they're participating there. So those are the kind of 2 linear points. One other thing, though, I'd mention that I think is actually more interesting and a bigger determinant of this over time is what happens with Apple's distribution, meaning Google's distribution on Apple. iOS 18, which is coming later this year, we know will integrate ChatGPT within Siri. We don't know what effect that will have on Google's distribution on Apple. We were hoping for some type of maybe announcement with Gemini working with Apple last night. We didn't get it. And so I think that's a piece of the puzzle that remains unknown that's probably more important even than those first two things I mentioned.
I want to end by asking about some investment news that we got, which is that Alphabet's expected to invest $5 billion more in the self-driving car firm Waymo. What do investors need to be monitoring about that increased investment into self-driving when, to your point, you just talked about Apple? Apple really took back their expenditures on self-driving cars in favor of AI.
Yeah, I wouldn't. I'm actually viewing that as kind of less incremental. The CFO did say on the call that it's kind of more or less in line with their current run rate. So it seems like it's more just them re-upping their investment. I think it's positive in that, you know, we know Waymo is making good progress both on their own service as well as with Uber in Phoenix. They're expanding to, you know, San Francisco, LA, probably I think Austin, Texas as well. So I think there's a lot of good progress being shown there. So I would say it's more of just like reinforcing the commitment to Waymo as opposed to ramping up investment, but certainly positive for Waymo in general.
All right, Brad Erickson, we appreciate you taking the time to hop on the phone with us here, RBC Capital Markets Internet Analyst. Thanks so much. LVMH falling this morning. You're looking at shares off just about 3.5%. Sales in the second quarter falling about 1% from a year ago, driving some fears that the company is falling victim to that broader slowdown that we have seen in the luxury goods market. And of course, this follows a surge in demand in the aftermath of the pandemic. So certainly it looks like that narrative surrounding LVMH here, Maddie, is starting to shift just a bit. When you dig into this report and exactly where we are seeing some of that disappointment, they talk about the fact that they were hit from some FX, some currency movements here, weakness out of China, also dragging down the results here from the most recent quarter. But I think the takeaway, though, is whether or not this points to the weakening of the consumer, even the higher end consumer, which has remained extremely resilient up until this point, and whether or not this is just more of a first half story, or is this something that's also going to spill over into the second half of the year, and ultimately what that means more broadly speaking for some of these consumer facing names.
Yeah, I thought it was really interesting, the CFO talking about aspirational customers in the U.S. still buckling, quote, under the pressure due to inflation and higher interest rates. That's taking a toll on purchasing power in the States. But they also talked about the China story, which is critical to watch for a lot of the retailers, saying that Chinese consumers were going to Japan to get their goods because of the lack of strength in the yen. And that was putting pressure on China sales. Sales in Japan, though, jumped over 50%. I'm interested in the degree to which we hear that story from other retailers, because if you're buying from LVMH, I don't know that you're the type of consumer who is also saying that they're going to plan their vacation around saving a couple of bucks on their LVMH purchases. So it'll be interesting to see how we can compare that to some of the other names in terms of China performance specifically. But to your point, I think what Citibank said is the kind of key takeaway here, which is that the sector of luxury is likely to remain out of favor in the near term. And if we're seeing luxury and low-income consumers struggling, who is going to be keeping up the economy moving forward? Yeah, sales in the Asia-Pacific region, including China, falling 14%. On the flip side, you've got sales actually in Japan up a little bit. A lot of that may be attributed to the fact that we do have the weak yen. So maybe that's contributing to the demand spike that we are seeing there in Japan. All right, coming up, Texas Instruments results calming investor concerns over a broader downturn. We got that stock up just about 2.5%. We've got that and more next. Texas Instruments shares are moving higher to the tune of over 2% after the chipmaker gave sales estimates that helped calm investor fears about a broader downturn in the chips industry. Now, this comes just days after NXP Semiconductors gave projections that were below expectations. So again, this certainly calming some of those concerns about a turndown in the broader chip sector. But I just want to run through some of the details that we got in this Texas Instrument print. Specifically, they provided a sales outlook signaling that some of the inventory challenges and headwinds that they'd been experiencing are starting to come off the pressure valve a little bit here. They also talked about the sales dip in industrial, that in automotive, that still remains, but their forecast was able to sort of come up against that here. You can see that revenue did come in line with expectations, adjusted EPS just a touch above. But following on what I was saying about the forecast, that was sort of pessimistic, and that followed the view that was offered up by their rival NXP here. They did interestingly say that their China business was looking good, so potentially that could be a tailwind for them moving forward.
Yeah, I think China returning to growth here, one of the standouts within this quarter. And I think when you take a look at the stock's reaction here today and compare that or contrast that to what we saw from NXP, it is alleviating some of those fears that we had seen on the street that maybe the worst isn't over for chip stocks. Maybe we would see more of a leg lower, or the recovery story would take longer to play out. Given that, though, we are still seeing slowing in the industrial and automotive sectors. Like you were saying, there are units, I should say, within the company there. They do have plans to heavily spend on new plans, so we will see. But again, at least the street focusing on the positives in this report and alleviating some of those fears that we saw play out from NXP. All right, let's get to three other big earnings reports here that we are watching this morning. AT&T, Visa, and Deutsche Bank. Let's kick it off with AT&T. You're looking at gains of just over 3%. The move higher coming after the company reported second quarter results. Maddie, what's standing out to me in this report is the fact that it beat market expectations on wireless additions here. Higher tier unlimited plans really proving to attract customers. They added 419,000 monthly bill-paying wireless phone subscribers here during the most recent quarter. Also, postpaid phone churn, that was falling, coming in at 0.7%, the second lowest reported for a second quarter.
Hey, crushed it on the timing there, Shauna. Amazing. Well, I'll try to follow that. I'm looking at shares of Enphase Energy, those shares moving higher after third quarter revenue came and beat expectations despite posting a miss in the second quarter. As a reminder, this is the solar equipment manufacturer. Those second quarter gross margin sales coming in higher than estimates. Management did say that the California market, which is key for solar panels, has stabilized. That is, of course, going to be critical to watch. Morgan Stanley, however, saying they're worried about downside risk to 2025. But as a reminder, solar is an interest rate play. So as the Fed cuts, that could be good for solar.
All right, there we go. We made it just on time. Let's wrap it up with Deutsche Bank. That stock falling here just almost 6% after the company broke its 15-quarter profit streak. So the first quarterly loss that we've seen in just about 4 years. It booked a charge tied to its legacy issues at its Postbank retail unit, also saying it's going to stop buying back shares. Despite this and some of the concerns that you're seeing play out on the street, I was going through analyst reaction here this morning, and the street's pretty positive. At JP Morgan saying results are strong across the board, and Citi overall saying that it was a solid set of earnings results here from the company. Despite that, though, we're looking at losses of just about 6%. All right, we got about 30 seconds here until the opening bell on the street. Let's take a look at the futures market because, again, we're seeing some pressure across the board. You've got the Dow off, or set to open, it looks like, in the red, as well as the S&P. The Nasdaq also under pressure. Now, the move lower in some of those tech stocks coming on the heels of the results that we got after the bell yesterday from Tesla and Google. We had the street taking issue with some of the profit numbers that we got out from Tesla. Also, when it comes to Google, some of the weakness in terms of the YouTube business. Also, the fact that capex spending being an issue here for the street. So again, that's being reflected across the major averages here today. And that's the opening bell here on Wall Street as we see some excitement from one stream at the Nasdaq, also from the floor of the New York Stock Exchange. You have SCAP, is it SCAP or SCAP? ETF ringing the opening bell here. So again, does look like we are under pressure across all three of the major averages here, Maddie, at the open.
All right, Shauna. Well, we are going to continue our coverage here because we've got Yahoo Finance's Jared Blickery standing by for a look at what's moving. Hey, Jared.
Hey, Maddie. I'm taking a look at those spot ether ETFs that launched only yesterday. And just a quick update. I got a tweet to share by James Seifert over at Bloomberg. He and Eric Balchunas have been all over the spot Bitcoin and ether ETFs. And now they're saying on day one, they now have 10.2 billion in assets across 9 different ETFs. Volumes on day one were over 1.1 billion for the group. Total net flows were 107 million. But this takes into account actual withdrawal of $484 million. That's negative flows from ETHE. That is the Grayscale Ethereum Trust, and that has actually been in existence for years, since about 2019. They are going to lower their fee, but they were just converted into a spot Ether ETF, and so you're seeing, similar to what happened with the spot Bitcoin, people coming out of there and joining some of these other ETFs that have sprung up. iShares ETHA, that was the #1 winner. They got about $266 million worth of flows. Now, I also want to take a look at the futures market, and let's just venture over there where we have copper is actually in a bear market. It has been down 8 days in a row. And let me just show you the ticker, HG=F. That's what it is on Yahoo Finance. Here's a year-to-date chart. And I just want to point out, this high that we saw in May, that was a record high. And from there to all the way down there, that is 20%. So copper in a bear market right now. Also want to check out WTI crude real quickly, CL=F. That is up 1%. Only a couple days ago, it had fallen from a support level, but today it is actually snapping a 4-day losing streak. So kind of mixed front on the commodities, but I am watching that copper bear market.
All right, Jared, we're going to continue to watch it too. Jared Blickery, thanks so much for breaking down some of the movement that we're seeing here at the open. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. Again, all 3 of the major averages kicking off the trading day in the red. We've got that and much more. You're watching Morning Brief. Taking a look at the tech stocks here today, you've got the Nasdaq falling off just about 1.7%. Now this move lower coming after 2 of the Mag 7 stocks, Tesla and Alphabet, reported mixed earnings reports after the bell yesterday, and it's tamping some of the investors' optimism on earnings this season. So does this signal, or maybe is this a worrisome signal for what could be ahead from some of those other Mag 7 names? For that, we want to bring in Brad McMillan. He's Commonwealth Financial Network's Chief Investment Officer. Brad, It's great to have you here. So I'm curious how you're looking at the results that we got from Tesla and Google last night, not specifically on those results, but ultimately what you think maybe that signals in terms of how high the bar is for Wall Street this time around, and maybe does it point to the threat of more pressure here ahead?
I think it does point to the threat of more pressure here, Sean. And I think there's a couple of reasons for that. First of all, when you're looking at valuations, when you're looking at multiples as high as they are for not just these two, but also all of the Mag 7, they're building in not just earnings, but also growth in earnings. And if you don't see that earnings growth, and clearly we didn't see that with either of those two companies, that means that valuation has to come into question. The gap between the Magnificent Seven and the other members of the S&P 500 even is so extremely large that for them to do that, they don't have to do well. They have to do incredibly well. And just for them to mean revert, which is what we're starting to see, means there could be a lot more downside ahead.
How much of the reaction, Brad, is tied exactly to how much these stocks have run up so far this year?
Well, I think that's just it. When you look at the gap between fair value and where they are right now, I mean, there's 2 points to this. One is you look at the reaction, okay, they're coming back to fair value. They're coming back to reasonable expectations. But then there's also an opportunity here because the valuations on pretty much the rest of the stock universe are much, much more reasonable. So as you start to turn away from the big cap stocks, the Mag 7, there's also some opportunity that we're going to see mean reversion in the other stocks as well. And that's an opportunity going forward.
Well, Brad, let's talk exactly about those other stocks. In your note that you sent over, you talk about how we could see some growth, specifically in consumer staples because of job and earnings growth and the working class doing well. Explain the thinking on that to me, because I've been fascinated by the very bifurcated consumer news that we've been getting out of these earnings prints from LVMH, even from the airlines. I'm seeing some signs of a struggling consumer kind of across the board.
I think there are some signs and things are slowing. You're 100% right. There's no doubt about that. But then when you look at the actual achievable income of most people, if you look at job growth, yes, it's down, but it's still very healthy. If you look at wage growth, that again, down, but still very healthy. So the actual purchasing power with respect to the average worker continues to grow at a very, very healthy way. Yeah, if you look at the chart there, you can see historically we're still very strong. So are things softening? Yes, they are. But are we seeing consumer spending continue to grow? We are. And I think one of the big deltas here, as you talk about the dichotomy here, is the more wealthy contingent. Yeah, maybe they're starting to pull back. They're starting to get nervous. But the less affluent population continues to spend what they make, and they're making more. So I'm very comfortable with that growth continuing.
So, Brad, what does that ultimately then mean for the soft landing scenario? What do you think this means for the Fed and what their next moves are likely going to look like? Because a lot of that optimism, I think you can argue, has been priced in at this point, or has it not?
100% agree, Sean. Everyone's saying the Fed is going to cut. I still don't think the Fed is going to cut. And we talked about this the last time I was here. You know, the question isn't when are they going to cut? It's why would they cut? Inflation is still too high. It's getting better, but it's still too high. Job growth is still strong. There's no reason to cut. And we're not seeing the economy overheat. In fact, this slowing that we're seeing is exactly what we want to see for the soft landing. So that being the case, when you look at the market, and again, we've seen this multiple times over the past couple of years, the market has talked themselves into a belief that we're going to cut. So we might see some short-term turbulence. In fact, we are. But the fundamentals remain pretty solid because the economy remains pretty solid.
I want to end by asking you about the Fed. Bill Dudley saying this morning, and he was the Federal Reserve Bank of New York president from 2009 to 2018. He said, I changed my mind. The Fed needs to cut now. Brad, I know you think the question is why and not when for the Fed. Does the thinking that Bill Dudley has talked about this morning change your thinking on the why for the Fed moving forward?
Obviously, I respect, Mr. Dudley's opinion, but I think one of the things we've seen so far in this is there's a belief that job growth has to soften. And again, we've seen this. I'm not going to believe it until I actually see it happen. There are reasons to believe it's starting to come down. There are reasons to have that opinion. It's certainly a valid opinion, but I'm not going to believe it happens until it happens. So no, it has not changed my opinion.
All right, Brad. Well, thank you so much for joining us and giving us your thoughts. We appreciate it. That was Brad McMillan. He is Commonwealth Financial Network's CIO. Taking a look at Visa now, shares down over 4% after its payment volume growth slowed in the third quarter. The payment company also reporting revenue that missed expectations, prompting concerns about a broader slowdown in consumer spending. And this is something that we have certainly been talking about across several names here. But you have a slew of changes to analyst ratings on the stock following this. You have Mizuho Securities, for example, cutting its price target, which from 275 to 251. That implies a 5% decrease from the last share price for Visa here. Going through some of the news that we got from this earnings print, obviously third quarter net revenue and payment volume falling. That was the kind of top line here, but also forecasting fourth quarter net revenue growth to be in the low double digits compared to the prior year period. So it is interesting to see how that might look moving forward. We also had a Jefferies analyst saying that it was a rare top line miss for net revenue from Visa. So perhaps a print that was a little bit surprising to the street here.
Yeah, when you take a look at what Mizuho's Dan Dolev was saying, also just more specifically, he was saying that the main issue was U.S. volume growth, right? And saying it indicates, quote, no meaningful excess growth versus PCE and implies further decline in Visa's share of the U.S. consumer spending growth. So I think that really just speaks to the crux of maybe the street's issue with this and why we are seeing shares under pressure. I believe we're off just about 3.5% still, which, just putting that in perspective, that would be the biggest drop that we've seen in almost a year. Actually, now we're off more than 4%, the biggest drop that we had seen since September. So there is some concerns here, at least from the part of the consumer, not to a different of a story from what we were talking about more broadly speaking when it comes to LVMH and the pullback that we are seeing, or a more discerning consumer there, not so much willing to spend, whether or not it be on those larger ticket, more expensive items like LVMH and what they offer, and also some of the smaller offerings as well. So again, they are seeing some weakness. A lot of that also having to do with travel. That's something that Morgan Stanley called out in their quick reaction here, saying investor focus on the slower domestic and cross-border travel spend in July. So again, this theme maybe of a weakening consumer, also similar to what we heard from some of the consumer staples companies, even though it's very early in the quarter. So far this quarter, it points to maybe this is the start of a larger trend that we could see here this earnings season.
Yeah, definitely something to keep monitoring as we await that upcoming Fed meeting as well. But coming up, crude oil is ticking higher. We're going to break down why that is right after the break. Let's take a look at the oil market. Crude ticking higher, on track to snap a 3-day losing streak. This comes after U.S. crude inventories fell for the 4th week in a row. That's according to data from the American Petroleum Institute. So here to discuss commodity moves, we've got Neil Dingman, Truist Securities Managing Director of Energy Research. And thanks so much for being here with us this morning. I want to talk about a very interesting part of your note that you sent over here, specifically about the potential impact of the election, Neil. Talk to me about what your call is for the price of oil and where you see that going if we have either a Democrat or a Republican entering the White House come November.
Sure. Nice to be here. I think at least for the remainder of this year, we see prices remaining around this level, the $80 level. I think what's caused, by the way, the last sell-off is just a little bit abatement of the geopolitical risk. But when you look up in the election, and especially when, again, if let's assume number one, former President Trump would take office in January, if he would win and take office in January, I think you would have immediately much less energy restrictions. I could go on all sorts of types of restrictions, from pipelines to drilling to federal acreage, et cetera. And I think just not only just the fundamentals of that happening, but the sentiment perception of that going on, I think could cause obviously the thought of production going, notably or materially higher, and as a result could cause prices to fall off at least 10%, if not closer to 20%. So I think there's a chance that prices, if former President Trump wins, that prices could go down as low as $70, high 60s, and the reverse. If Kamala Harris is elected and the Democrats stay in office and a lot of energy restrictions are maintained, I think you have an angst that production will potentially even fall from current levels as sustainable fuels are focused. And as a result, I think that could cause prices to go up even over $90 a barrel. So I think there's a big range, somewhere, maybe a $20 or $25 range potentially is that high, depending on who the outcome of the election.
Neil, could it be even higher? I guess I'm curious how, from your conversations, and maybe it's too early at this point, but how industry insiders are thinking about a potential Kamala Harris presidency, just given her record, her track record on energy, some of the rhetoric that she has used. And I think there is a question out there as to whether or not we will see even a ramp up in some of those regulations if she were to win the presidency, even versus what we see under the Biden administration today.
Oh, no doubt. I think there's a question that she could double up on the IRA. There's just a lot of steps that can be taken very quickly. And, again, especially when you look in the U.S. with natural gas, the one thing that's desperately needed with natural gas is, again, pipelines, and I would call it a bit less restrictions so that these pipelines can be added, can be converted. And if we see this go the other way, you're exactly right. I think prices, 90 is probably even low. I think there's a potential, as you pointed out, for even higher if the restrictions even, are jumped. So I think there is a big chance that you could see prices much different. Maybe not natural gas prices as much, because again, I think the continued LNG AI demand is going to probably continue to push that a bit more. But certainly, oil prices can have a huge variable.
Talk to me about that AI demand, Neil. We're seeing some of the big tech names like Alphabet dinged this morning because of their AI capex. In a couple of years, if they change their tune and decide that they should not be devoting so much money to AI, how much risk does that hold for the energy sector?
Not a ton yet. The build out has been pretty minimum. Kinder Morgan mentioned it on their call last week. I expect Williams companies to announce it on their call. Very few of the, EQT, their call starts here in, I think, about 30 minutes. I'm sure they're going to talk about that a lot. But there's been a lot of talk about it, but there hasn't been any specific build out. And I think there's a bit of a wait and see by my energy companies to decide where the data centers are going to go, what the demand might be once they're going to be built, all those sort of things. So I don't see too much downside yet. But again, I think the upside is going to be just the magnitude and sort of locations of those data centers.
All right, Neil Dingman, always great to get your insight here. Truist Securities Managing Director of Energy Research. Thanks so much. Well, coming up, big tech continuing to ramp up its AI spending, but one Wall Street bear isn't convinced that it's necessarily going to pay off. We've got more on that next. We're in the midst of big tech earnings with a big focus on capex spending. Now, Alphabet warning this week that capex is going to remain high as the company ramps up its AI efforts. One Wall Street bear, though, isn't convinced that all of this spending is paying off. Here's what Mike Wilson, Morgan Stanley's chief investment officer, chief U.S. equity strategist, had to say on Yahoo Finance's Opening Bid podcast this morning.
AI is sucking all of the oxygen out of the room. So it's not just one company, but now I think we are entering that dangerous part of the story where we need to see it in the numbers. Okay, you know, as I like to say, I see AI everywhere except in the numbers. You know, outside of a few companies where it's obviously been dramatic, it hasn't really driven revenues and earnings anywhere.
My takeaway, and it's a great interview, everyone should check it out. It's up on Spotify now. It's up on Yahoo Finance's homepage. But when it comes to AI and what he was saying there, I think is a question that you and I have talked to many strategists about over the last several quarters. And ever since this AI theme and AI excitement has really started to play out in the markets. And I think now that conversation is now turning, and you can even see it in this morning's reaction to some of those tech names that we got here over the last couple of days, is it's really turning into a show me story. And there are companies that that are clearly benefiting from their AI investments right now, but there has been some names that have been caught up within the hype. And I think the pressure is on those handful, or more than a handful, basket of stocks now to show and prove to Wall Street that their AI investments are paying off. And this is how it is helping the business. And I think that is the key question going forward as to how much maybe Wall Street has gotten ahead of the curve or ahead of some of the, actual facts and how this is playing out in terms of just really listening or reacting to the excitement versus what it is showing us on the fundamental side of things and whether or not it's actually fundamentally changing and helping those businesses.
And how long are investors going to be willing to wait for these investments to be proven out? He did kind of support his bearish call earlier in the interview as well. He talked about the broadening out that's sort of happening right now, but then he said, our view is we don't really believe it. It makes sense that he doesn't believe that there's a broadening if he also thinks that there's going to be pressure on AI, because he is one of the only surviving bears on Wall Street. And that's what I think is so fascinating. We saw Marko Kolanovic getting essentially ousted from his position because he was kind of one of the only remaining bears in this bull market rally that we've seen so far. We talk a lot about how you justify being a bear in this environment when we've had over 35 all-time highs to this market so far this year. So I'm always fascinated when you talk to someone with like a different call, because you don't always get that. He talked about the deceleration growth environment and the broader economy and how that could play into stocks. To believe that, you also have to buy that the economy is an indicator of the market and vice versa. I don't really know that that's true given what we've seen in some of the earnings prints, but it is fascinating to just get a sense. This interview really gets you insight into his thinking and his mind. So I can't wait to listen to the whole thing after our show.
And everyone should check it out. Be sure to check out the latest episode of Yahoo Finance's Opening Bid. That is with Morgan Stanley's Mike Wilson. He's on with Yahoo Finance executive editor Brian Sozzi. That's live now on our homepage and also on Spotify. So make sure to check it out. We'll keep right here on Yahoo Finance. Coming up, we have fresh manufacturing and housing data out at the top of the hour at 10 a.m. Eastern Time. We're going to dive into those numbers and tell you what it might ultimately signal about where we are in this economic cycle. We've got more on that next on Catalyst. It's just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets here today.
We've got a few key pieces of economic data crossing the wires now. S&P Global manufacturing and services PMIs. We've also got new home sales, so we'll get you the latest readings there in just a few moments.
And tech sparking a sell-off here today after the first two Mag 7 companies reported quarterly results. They disappointed the street. Investors now looking ahead to Amazon, Microsoft, Apple, Meta, all out here over the coming trading days. And again, you got the Nasdaq right around the lows of the session.
And also, Vice President Kamala Harris held her first campaign event as the 2024 presidential candidate for the Democratic Party in Wisconsin. We'll keep tracking the latest with the election and talk about how it could impact markets moving forward here.
All right, let's get to some breaking news that we have out here at the top of the hour. We're getting the latest reading on new home sales, falling to 617,000. That was below what the street had been expecting. New home sales falling 4,000 in the month of June from the prior month here. Median new home price actually declining, down about 0.1% on a year-over-year basis to $417,300. Average selling price was just over $487,000. Homes for sale in June, it actually rose 0.8% on a month-over-month basis. Now the month supply was at an average of 9.3 in June, and that was up from the prior month here. But again, overall new home sales falling to 617,000, coming in below the street's expectations. And it was a continuation of the story that we were talking about with existing home sales yesterday. And that's the fact that mortgage rates, given where they are right now, given the fact that home prices, I guess at least on the new home front, there has been some improvement here from a year-over-year standpoint. But again, the fact that home prices remain very high, not too far from those record highs. Many people who are out there wanting to buy homes simply cannot afford it right now. And we're seeing a bit of a chilling effect across the housing market, Maddie.
Absolutely. I also want to hit on that PMI data that we're getting in S&P Global manufacturing PMI data. It did rise, but the details a little bit less of a bright picture here. Manufacturing specifically disappointing expectations, coming in at 49.5 versus the 51.6 forecast. Services, though, and the composite did beat economic forecast. It was the best reading for those surveys since the spring of 2022. So the details under the hood, not as great as the headline number here, which was 56, which was above the number that was anticipated for PMI here. So it's interesting. The data could, suggest that the economy does continue to expand thanks to that services sector, but we are seeing some softness when you look under the hood. And this is a really big question mark for the Federal Reserve moving forward here, because if services spending continues to fuel growth in the economy, does that give them the soft landing scenario that they're looking for, or does it lead to a continued fueling of inflation moving forward here? Though I guess one of the things that, too, as I'm kind of looking at, I have one analyst saying that the survey does suggest a Goldilocks scenario with GDP coming in around 2.5% and suggesting inflation hitting 2% in the third quarter here. But the employment data not as strong as July, so that could also be a red flag, certainly a mixed picture in the PMI print.
Yeah, Maddie, when you take a look at the average prices here, charged for goods and services, that rose at the slowest pace that we've seen since January, the second slowest rate actually that we've seen since October 2020. So that also maybe points to the Goldilocks point that you were just saying in terms of the quick reaction that we're getting to this breaking news.
Absolutely. All right, well, we're going to continue the conversation around this data. We've got Hugh Gimber, JP Morgan's global market strategist here. Hugh, it's great to have you on. So I want to start on this PMI print because I can kind of pick whatever narrative I want from the data, it seems. What narrative are you pulling from PMI data today?
I think a mixed picture is a very good summary. What this really tells me is that the path to a soft landing for the Federal Reserve is still open, but it is increasingly narrow, because when we start to analyze all of this economic data that's coming through, what you're looking for is the perfect combination of growth holding up just well enough to keep the economy moving forward, but not too well, and reigniting inflationary pressures. And so when we translate that into how we think the Federal Reserve will be moving over the coming quarters, I think the case for them to start lowering interest rates is quite clear at this point. They've seen enough improvement in inflation. They've seen enough of a weakening in the labor market data to be approaching that first rate cut. But importantly, we think they move quite tentatively, because you're certainly not looking at PMI data today. Services at 56. and saying this is an economy that needs immediately lower rates and sharply so. So in my mind, 25 basis points a quarter is probably the right starting point for the Fed, and only accelerating that once they get much weaker economic growth than the data is showing so far.
Do you think this data moves the needle for any Fed voting members who might have been still weighing the potential of a cut in July even?
No, I personally think July is off the table. There's just not really any need for the Fed to come out and surprise the markets at this point. You look at how markets are priced, they are more than fully priced for a move in September, but a July decision I think would come as quite a shock. If anything, the Fed might be worried about sending the signal to the market where people start saying, well, hang on a minute, what does the Fed know that we don't? So no need for them to be moving too quickly. I actually think taking a slightly longer term perspective, when you look out now into how the markets are seeing the Fed move in 2025, there looks to be a little bit too much in the price here. You've got more than 100 basis points of cuts priced by just March. That means that the Fed is going to need to go by more than that once a quarter pace that I've laid out as my base case. So certainly no cause for alarm in the data today, but it talks to this narrow path where Goldilocks has been the market story for the past few months. It's helped the rally that we've seen in areas like small cap. But ultimately, our message is with resilient growth comes resilient inflation. And therefore, this combination of still booming GDP, but with a continued softening in inflation, to my mind, is going to be a harder and harder one to achieve over the coming months. We're going to need to see some further slowdown in economic activity to keep the Fed on track in terms of moving back to 2%.
So then, Hugh, what does that tell us about where you're seeing opportunities? It sounds like maybe there is some opportunity when we are seeing this rotation. It does sound like maybe you think that there's still a way to go in that trade, but are there better bets at this point than the small caps?
I think that's right. So this could well be the first earnings season in 5 quarters where you see positive earnings growth from what I'd call the S&P 493. When you strip out the Mag 7, the rest of the market is finally poised to move back into positive earnings territory. So we do see good opportunities in broadening out across the US market. But in my view, this is still a time to be focused on large versus small cap. And that comes down really to the interest rate exposure and how that differs across size. So when you look at the S&P 500, only about 5% of outstanding debt is floating rate. The majority of the large caps debt is parked well out into the future, even 2029 and beyond. But compare that 5% of floating rate for small cap, where you've got close to 40% of outstanding debt as floating rate. And so the perfect environment for small cap is one where growth holds up, but interest rates fall quickly, and therefore you take away some of that debt refinancing pressure. And that's where, again, kind of coming back to the data that we're seeing at the moment, I find it hard to combine a picture of still really solid growth and rapid rate cuts, which I think is what markets are getting a bit carried away on. So for me, the rotation holds, looking at broadening opportunities across the S&P 500, but not yet the right time to be moving too far down the size spectrum.
All right, Hugh Gimber, always great to get your insight. Thanks so much for joining us, JP Morgan's global market strategist. Let's take a look at Tesla and Alphabet. Both are under pressure here this morning. Investors were looking for a bit more from both of those magnificent 7 companies in their latest results. You've got those stocks pulling the Nasdaq lower right around the lows of the session, off nearly 2%. When you take a look at the drops that you're seeing in Tesla and in Alphabet today, should investors be viewing this as a buying opportunity? We want to bring in Nancy Tangler, Laffer Tangler Investments CEO and Chief Investment Officer. Nancy, it's also very important to point out that you're a shareholder in both Tesla and in Alphabet. So let's start there, and let's start with Tesla. We'll unpack that first. How are you viewing this sell-off that we're seeing in reaction to the stock, and should investors be viewing this as a buy the dip opportunity?
Well, I've often said that you should buy Tesla during periods of chaos, and we were doing just that earlier this year. And I was on your air in April and suggested that it was a good time to add to holdings, and the stock's up 74% through yesterday. So back out today's 8%, 9% decline. I don't think you're buying this stock for EV growth. You're buying it for the other elements of the business. Our focus has been on the mega pack battery, utility grade battery business. Grew 100% in revenues year over year last quarter. It's fastest growing, most profitable business, and Elon Musk announced a China factory that will triple output. And that's been the issue. It hasn't been a demand problem. It's been a supply problem. And so if you add that to the robo-taxi business and then full self-driving, I think you're buying a company that's an AI company and less so a car company.
I want to ask you something that our autos reporter flagged to me this morning, Nancy, which is this idea that maybe the energy storage business for Tesla is sort of like Amazon's AWS because of the degree to which it contributes to the company's growth. Would you agree with that characterization, given that you also look at Amazon?
Yeah, I would, and that is really what drove us to add to our holdings. I went on a factory tour with a small group of investors in California at the megapack battery facility, and it's impressive. The growth has been impressive, the profitability. They are the low-cost producer in that particular segment, and so we expect to see the growth really drive earnings in the next few years. But right now, the headline readers are focused on EV sales. Yet I would just argue that even in that aspect, no matter which administration takes over, I think Tesla is well poised to gain share relative to the other EV makers in the coming years.
Nancy, since you mentioned the election, I have to ask, Elon Musk saying that he's rolling back his $45 million a month donations to Trump. Not getting into the details there, but to what extent do you see Musk's support of Trump as a potential headwind for EV sales moving forward and therefore for the stock moving forward?
I mean, listen, Elon is the one CEO you don't want to underestimate, yet he is consistently underestimated. He actually takes a page out of Trump's playbook where he says something and then he walks it back and it's provocative and he gets headlines. I just don't, just as the Twitter purchase ultimately did not tank Tesla's sales, but it was a great buying opportunity. That's actually when we reinitiated our position in January of 2023. That was an opportunity, and that's what I mean when I say buy it in periods of chaos, because I made that mistake once when we didn't do that, and I'm not going to make it again.
Learn from past mistakes. That's the best piece of advice I think anyone can get. Nancy, let's move on to Alphabet. That's another stock that's under pressure here this morning. Concerns there, it seems to be surrounding the YouTube business, also the capex spending. I'm curious as to whether or not are either of those parts of this report, are either of those worrisome to you, and why or why not?
No, they're not. I mean, I think I wrote in my talking points that we had initiated position in Broadcom when the street punished it for the purchase of Computer Associates. If it's not the street's idea, often they take the stock down. But if you look at the report overall, they beat on revenues, they beat on earnings, margins expanded by 325 basis points, which drove operating revenue and came in 5% ahead of expectations. Search was up 14%, cloud was up 29% due to AI workloads. So the capex spend to me is protecting the moat. And they are seeing improved engagement and customer satisfaction in search due to AI inputs. So I think one of the things that we have to remember is that in the short term, the hedge funds and the algorithms, they love to sell off on whatever the particular topic of the day is, but usually that volatility is a friend to the long-term investor. And I would just add one last thing. Free cash flow after CapEx is still $70 billion in 2024. So I think this is much ado about nothing. And I have a lot of respect for Ruth Porat, who will be the new Chief Information Officer and President. So we will use this as an opportunity to add to our holdings.
Nancy, I want to get a sense of what you think the better bellwether is for other big tech names from the Alphabet earnings. Is it the miss on YouTube revenue that could be indicative of a broader issue within the ad revenue space, or is it the market's reaction to that capex spend? Which of those two do you think is that narrative that you think the street's going to go with?
It's a great question. It's the latter, I think. I mean, the ad revenue business, we're not buying Google, for example, or Alphabet for advertising. We're buying it for the cloud business and the generative AI opportunities. I do think that that's the new hot button that analysts are going to be focused on because what you're hearing, the counter argument to mine, which is AI use cases are increasing, exploding really, is that this is a mania and there was too much spend. I was managing money in the 1990s. This is not the internet bubble. This is the beginning, early days of a transformative technology that will change the way all of us work and will improve productivity. So I'm going to, once again, I'm going to use the volatility to as my friend and add to holdings in some of these names, despite what Wall Street thinks.
All right, Nancy, always great to have you on. Thank you so much. I really appreciate it. That was Nancy Tangler, Laffer Tangler Investments CEO and CIO. Moving on to Washington, Vice President Kamala Harris held her first campaign event as a presidential candidate in Wisconsin on Tuesday. She thanked President Biden for his endorsement and touted fundraising efforts so far. Let's listen.
We just had some breaking news. We just had the best 24 hours of grassroots fundraising in presidential campaign history.
With just under a month until the Democratic National Convention and a little over 100 days till the election, what is next for the Harris campaign? Our very own Rick Newman is here with the details. Rick, it's great to have you here. So obviously, Harris, they're talking about the record-breaking fundraising in under 24 hours for a candidate, but specifically there was this focus on the number of individual donations. Talk to me about what that means about the potential voter energy and sentiment around Harris heading to the polls in November.
It tells you that individual voters are fired up to support Kamala Harris, and that the fundraising number, I believe, is now around $126 million raised in small dollar donations since she became the leading candidate for the Democrats and Biden stepped down. That money is really important. I mean, people hear millions of dollars here, millions of dollars there, super PACs. Some people donating, rich people donating $50 million and stuff like that. Those small dollar donations go straight to the presidential campaign. So the campaign itself can use it for all the nuts and bolts of getting out and winning votes. That means opening offices in every corner of every swing state. Phone calls, hiring people. Some of it is advertising. That is really important, and that's different from the super PAC funding, which doesn't. You can't really do all of those things. That's used for other things like running ads. I think more importantly, it just tells you that she really has generated excitement among Democrats. She's up a little bit in the polls, so she's gotten sort of the honeymoon bump you might expect. That doesn't mean she's going to keep it. This is going to be a tough race all the way through, and the Trump campaign, it was planning to go after Joe Biden, so they're retooling their campaign, figuring out how to attack Kamala Harris, and they are going to do that for sure. But if you're a Democrat, it's a good restart.
Rick, what do you think Kamala needs to focus on and the Harris campaign needs to focus on? Because you recently wrote about, yes, there is a lot of excitement surrounding Harris right now, and ultimately a lot of backing. Clearly, we can see that by the donations, but inflation and the economy is still going to be a very sticky issue potentially here for Harris over the next couple of months.
Right, and I wrote about some election forecast models that are based on the economics in swing states. What's the inflation rate in Pennsylvania, Michigan, Wisconsin? What's the unemployment rate? How do people feel about jobs? She's going to have the same challenge Biden would have had on inflation, which is, how are people going to feel about inflation by the time they decide whom to vote for? Are they going to still be focused on food prices, for example, that are up like 23-24% since Biden-Harris took office and have risen by a little bit more than incomes? Or are they going to say, well, the trend is going in the right direction. I'm starting to feel good about inflation. Maybe we will have a Federal Reserve interest rate cut. So people will say, yeah, life's getting a little more affordable. Enthusiasm for Harris will not necessarily overcome swing voters' concerns about the economy. And I mean, there are a bunch of different challenges in terms of which demographic she's strong with, which demographic she's weak with. But one of the most important things she needs to do is boost voters' opinion of Democrats' ability to handle the economy, because it's still much lower than their belief in Trump being able to handle the economy pretty well.
All right, Rick, always great to get your insight. You're going to be a busy man over the next several months. We'll be talking to you probably once again tomorrow. All right, Rick, thanks so much.
Bye, guys.
Keep it right here on Yahoo Finance. We got much more of your market action ahead. Again, we're just about 50 minutes into the trading day. You're looking at a sell-off led by the tech stocks. You got the Nasdaq off now just over 2%, right around the lows of the session. You got the S&P off about 1.5%. More on that when we come back.
Let's get to some trending tickers. Shares of Tesla moving to the downside, the company missing analyst expectations really across the board. And CEO Elon Musk confirming the delay of an event that's meant to showcase robo-taxis on that latest earnings call. So here to discuss, let's bring in Itai Michaeli, Citi U.S. Auto Parts Analyst. Itai, thank you so much for being here. So I know you kept your neutral rating on the stock, but you lowered your price target. What would it take? What is the single thing that you would be looking at to bump up that price target again on the stock?
Yeah, we're trying to be very tactical with Tesla, and thank you, of course, for having me, where we're looking for a couple of things. First, we'd like to see consensus estimates come down. We have been below consensus really all year, and we want to see an opportunistic entry point potentially with the stock heading into some important events. You know, with Tesla today, it's a lot of push and pull between the core auto business and EV business that has had some struggles and fundamental headwinds. Again, some of the really exciting opportunities are coming up, both the new EV models you mentioned, as well as the robo-taxi day in October and other AI opportunities. The stock has had a pretty good run here into the quarter, had it gained momentum off the Q2 delivery beat, we did learn last night that the auto gross margin, excluding credits, was below expectations. It's a reminder that the auto business does still have some fundamental challenges. So for us, it's really about kind of setting up the stock price relative to consensus in anticipation of some of these important events, particularly the October robo-taxi day. But right now, we are still neutral on the stock.
Itai, do you think the robo-taxi day is going to be a catalyst here for the stock, or is it going to be more of a show-me story at this point in the cycle, just given the fact that it has been delayed and now there's lots of questions about whether or not even the timeline that Musk laid out last night, whether or not that's even realistic?
Yeah, it's a great question. I think it's all about the level of credibility in the actual deployment plan for Tesla. If the event is reminiscent of the 2019 Autonomy Day, that could receive some pushback and disappointment. But if the company is able to actually leverage its advantages, which we think are really a low-cost robo-taxi platform, the hardware costs, as well as, of course, their end-to-end AI capabilities, which are very strong, into a credible deployment plan for robo-taxi and other mobility services, that could actually be perceived well. Now, the question is there a credible deployment plan that we think they could actually undertake? And the answer is yes. In a published report back in June, we did articulate opportunities for Tesla to deploy AV in easier domains. So not like urban robo-taxis, but areas where they can leverage their lower cost to deploy in easier domains. So the bottom line is, if we are able to get a more credible deployment plan, and investors can say, I see how in the next couple of years this can lead to incremental high margin revenue and new mobility services for the overall Tesla ecosystem, that actually could be taken as a positive.
I want to switch gears a little bit, Itai, and talk to you about Ford, expected to report their second quarter results after the bell here. What are you going to be watching in those earnings?
Absolutely. Yeah. So we are expecting strong results. We got good numbers from GM yesterday. Ford also did have some good news recently in terms of F-Series Super Duty capacity expansion plans. And so we do expect strong Q2 and a stronger outlook. I think one of the things we talked about in the last several weeks is, for both automakers, the second half outlook as compared to the first half outlook does create some optics where the second half is going to be a bit weaker for seasonality and some other factors. I think that sort of has hurt GM stock yesterday and this morning as well. And so there are some tricky optics into the setup for the quarter. But overall, we do expect a strong result and a favorable outlook, really on our underlying call for U.S. auto demand. The real strong trends we're seeing and have been seeing for a very long time in the pickup truck market, as well as some of Ford's internal execution as well. We'll be watching the Ford Pro segment very closely. That had a very, very strong Q1. We're expecting good results here in Q2 as well. And of course, kind of taking a look at what the second half outlook that they articulate will end up looking like.
All right, Itai, always great to get your insight. Thanks so much for joining us here as Citi's U.S. Autos and Auto Parts Analyst. Thanks so much. Well, Elon Musk in recent weeks announcing that he will be moving the corporate headquarters for SpaceX and X to Texas. Musk basing the move on a new California law that he called, quote, the last straw. Zooming out, though, the larger question that's looming is whether or not the recent move here by Musk is going to spur other companies to follow suit. Yahoo Finance's legal reporter Alexis Keenan has been digging into that question for us. Alexis, what did you find?
Hi, good morning. Yeah, so will Musk kind of spotlighting this issue spur other companies to follow suit? Corporate legal experts, corporate attorneys, they say maybe, but for now, don't hold your breath. Basically, what they say is that there's so many ways to look at where a corporation really calls its home, right? For one, you have the headquarters. That's what Musk was talking about last week with those SpaceX and X moves, saying he's going to move the headquarters from California to Texas. But you also have the state of incorporation, where Delaware is a popular pick, home to 67% of Fortune 500 companies still. And then you also have the economic center for companies. And that really has implications for their tax bases, where they're going to have to pay hefty fees to Uncle Sam and to the state. Now, the headquarters being just part of that equation. But over time, these legal experts say there could be a more significant shift if Musk is moving, in fact, his workforce, for example, his business operations, all shifting to Texas. That could be really significant. But they say at the same time, that's going to be very very difficult because of California, because of Silicon Valley being such a talent hub for tech workers, that's not going to happen automatically, despite Texas maybe attracting a lot of tech workers over the last, let's say, 5 to 10 years, that's just not something that can happen right away. There's another wild card, though, and that is a new Delaware law that was passed and signed into law last week. And what it does is it lets corporations cede power to individuals, to entities, and it takes away shareholder power. And that's a big question of whether or not that's something that will make corporations stay and keep foot in Delaware, or if it's something that they say, hey, shareholders don't like this, and we're going to move our operations as well. So a lot of moving parts here, but if you take a look at Delaware, still a top state for corporations where companies can sue and be sued, also known widely for what Elon Musk has been contending with is its Chancery Court that has sophisticated business law acumen and is able to process equitable disputes there in that court. So very popular. But if you look in 2023, 59,729 companies chose to call Delaware their incorporation state. That was up from 2022, where it had 58,662, and then bouncing around a little bit because in 2021 they had 62,500 incorporations. So the bottom line here is this is a question that has yet to be answered and something that we'll keep watching here.
All right, Alexis. Well, thank you so much for bringing us your reporting on this. As always, really appreciate it. Moving over to another trending ticker, we are watching AMC announcing preliminary results this morning. The company projecting a loss of $32.8 million for the second quarter after reporting $8.6 million in profit just a year ago. So just to run through some of these numbers from the 2Q preliminary results, adjusted EBITDA came in at $29.4 million. That was 84% lower than the 2Q 2023 number was, but it was 2 times consensus. So there is this question out there about whether or not the worst could be over for AMC as we move forward. If you look at the stock reaction, that is not necessarily the story that the street is buying here. Having said that, this could be moving forward a show me story when it comes to the free cash flow for AMC moving forward. Common shares outstanding also grew by 58 million in the second quarter, raising cash and equivalents by over $140 million, and that is certainly something that investors were watching here. But that adjusted EBITDA number coming in, again, 84% lower than this time a year ago. That is a really big decline there.
Yeah, their CEO saying that, as we accurately predicted and previously disclosed, the prolonged actors and writers strike that happened last year in 2023 severely reduced the number of movies that are being released theatrically here in the early months of 2024, going to some of the points that you were making earlier here, Maddie. And he's saying that this explains the weakness in our prelim second quarter results as contrasted with the same quarter of a year ago. So again, blaming much of that weakness on the writer's strike last year, and exactly what that means here for not only AMC, but industry-wide, as some of the weakness that we could see here this quarter. Again, the stock was initially halted after these prelim results were released. It did resume trading, was initially down about 1%. We've seen an extension here of those losses as the morning has progressed. We're now off just about 5%. Remember that this is a name that has been caught up in the meme trade, caught up in the meme rally time and time again, one of the most heavily traded names here on StockTwits. So again, or I guess most mentioned names here on StockTwits. So again, when you take all that into account, it's kind of hard to figure out some of these moves, even though there's a lot of positive. We are seeing the stock off just around 5%. Many times, stock doesn't necessarily trade in tandem with fundamentals. So again, just important to keep in mind when we're trying to make sense of why the stock is trading down just about 5%, when at least when you take a look at this report, and it could be pointing to the fact that, like you said, Maddie, the worst could potentially be over here for AMC, but we'll see.
Yeah, it's really interesting too to look at some of the commentary on these calls. They talked about the writer's strike, for example. We didn't hear some of their peers in the space talking about the writer's strike, so sometimes that can be a sign of executives grasping for some explanations for a tough quarter. Well, coming up, shares of Otis are under pressure after reporting second quarter results. We'll talk with the Otis CEO, Judy Marks, next, right here on Catalysts.
Shares of elevator and escalator manufacturer Otis are under pressure this morning after missing analyst expectations for revenue in its second quarter, also lowering its full-year revenue guidance, citing challenging market conditions. You got the stock off just about 5%. When you dig deep, though, into this report, there was still a lot to like for investors here. The services part of the business, that was a strength here in the most recent quarter. We want to bring in Otis's CEO, Judy Marks, joining us now, and also our very own executive editor, Brian Sazi, bringing us this interview. Judy, it's great to see you. So talk to me about the quarter, some of the trends that you're seeing underneath the surface, and ultimately what you're hearing from customers at this point in the cycle.
Yeah, Shauna, Brian, great to be with you. Listen, we had a solid quarter. We are a service-driven business. Last year, over 60% of our revenues and 90% of our profits are driven by our service company, and we were strong there. Our portfolio grew 4.2%. Our organic revenue was up over 5% in service, modernization up 6%, and both of our segments drove profitability. It was our highest margin quarter since we became independent at 17% with 110 basis points of margin expansion. What we've seen, though, is some challenges, some challenging economic times in China, specifically in our new equipment segment, where volumes are down because consumer sentiment is not driving the property market to return or really stabilize to a level where people are now continuing to buy real estate. So we've offset, and in our outlook, we're still going to grow organically this year, 1% to 2%, but we have taken our outlook down from what was a little higher than that, while holding our profitability, while actually increasing our EPS. We had 15% EPS growth this quarter, and we're showing 9 to 10% in the guide. So, but I think we're being realistic about what the lack of recovery in China and some of the headwinds we're seeing there.
Judy, good to see you. And look, we've talked a lot about conditions in China, and it looked like Otis is calling out a 10% to a 15% drop in China this year. It seems like things are getting worse, and I would argue it's not an Otis thing. It's an economic environment thing. Take us inside that China market. Is this just a reflection of China overbuilding and there's just ghost buildings sitting unoccupied and nobody needs to buy elevators or escalators? Is it that simple?
Actually, it's a little more complex, and I think you're seeing it in the luxury brands on the consumer side. I think you're seeing it across the board. The Chinese government's driving for change and has made multiple efforts to encourage people to invest in real estate and to buy homes. There are still over 400 million Chinese living in rural areas that the Chinese government wants to raise from poverty and bring them to urbanized areas. So while the market, we're saying this year, will only be between 425,000 and 450,000 elevator and escalator units available in the new equipment market, it's still the largest market in the world. It's healthy. And I think what's important, Brian, is when we spun, besides growing our share in China and focusing our 17,000 colleagues there, we knew we needed to grow our service and our modernization business. And now a third of our revenue is in service, which is 2x 4.5 years ago when we spun. And we're continuing to grow that, day after day, quarter after quarter. So our China business is healthy, but the new equipment segment has slowed down, third year in a row. And we're saying the market's going to be down 10 to 15% this year, which is pretty close to the last 2 years. So it's a pretty big drop, but the team's delivering. We're driving cost out. We're becoming more productive. They're in a deflationary period, so commodities are less. Competition's tough, but we're winning our share.
And I always like asking you about China, Judy. Of course, you're on that Caterpillar board too. China, a key market for them as well. What gets that market back to growth? What has to happen?
Well, listen, I think consumer sentiment has to change. And there are times that we see that in especially in the tier one cities. Tier one did better than any of the other series. So you're talking the real large urbanized areas. There's still growth. When you go to China, I was there in March, I'll be back in November. You still see ample construction. You see cranes in lots of places. The smaller cities are slower to recover. And we're going to continue, we think, to see that over time.
Judy, you sit on the Business Roundtable, and I bring that up. Obviously, there is a massive focus on November, ultimately what the outcome of the election is going to mean across industries. I'm curious, Starting on the trade front, we've heard ramped up in rhetoric, even from former President Trump in terms of what he wants to implement, from President Biden. Now there's questions about what Harris's policies could potentially look like. If we do see any sort of increase in terms of tariffs, what ultimately does that mean for your business?
Yeah, listen, I think tariffs impact the American economy. They impact the American citizen no matter what they buy. We've seen that since tariffs have continued to go up. Regardless of which party wins, we need a pro-growth environment that allows U.S. businesses that are multinational businesses to operate in a high-quality trade environment that everyone understands so that we can compete. And when we can compete overseas, it drives additional economic growth and jobs here in the U.S. And that goes across all industries. A trade war, a tariff war is not in the American economy's best interest, nor in our citizens' best interest when it's going to create imbalance. It's going to potentially create other issues for American companies to continue to either export or to grow our businesses. And all we want is a pro-growth environment that allows us to continue to make a difference for the lives of Americans.
Judy, I'm just interpreting, just trying to understand something like this in real time. Are you and your fellow CEOs on the Business Roundtable, are you concerned about working with another Trump administration? When I hear things like a 10% universal tariff, I mean, to your point, that can't be good for the bottom line of your company and many companies like yours.
Listen, we will work with either administration, and we understand there will be new policies put forward, and we just want our voices to be heard and the impacts of some of these moves the government may choose to make clearly understood, both the consequences they can think through as well as the unintended consequences. But we really believe high-quality trade agreements, the way we've operated for many decades, creates predictability, Brian. We want to be able to invest. We want to be able to invest at home. And we want to be able to invest in very focused investments in other countries that, again, will drive U.S. jobs, U.S. intellectual property, R&D here in this country. And with predictability, we can continue to do that.
Judy Marks, thank you so much for taking the time to join us here this morning, CEO of Otis. We really appreciate it. And, of course, our thanks to Brian as well for bringing us this conversation.
Thank you.
Coming up, how is AI playing a role so far in second quarter earnings? We're going to discuss when we return. Alphabet is spending big on AI, with capex totaling more than $13 billion in the most recent quarter. On the tech giant's earnings call last night, Alphabet CEO Sundar Pichai touting AI efforts, saying AI is, quote, driving new growth, and its, quote, AI infrastructure and generative AI solutions for cloud customers have already generated billions in revenue. But how is Wall Street viewing that jump in AI spend? And are investors maybe a bit more skeptical about some of the hype that we're seeing? Here with more is our markets reporter, Josh Schaefer. And Josh, you've done a great job compiling more than 30 charts for us, Yahoo Finance's chart book. But you were sent some charts on AI spend. And more specifically, I guess, how is Wall Street looking at this?
Yeah, so we got a good look at sort of what's been priced into the market and what's sort of not priced into the market at this point, right? And I think you could argue you see Alphabet shares off a little bit today, but largely over the last year, you've started to see that AI trade start to get priced in. So Goldman Sachs sent us an interesting chart kind of breaking down the AI trade into 3 different buckets. You have an infrastructure bucket, an enabled revenues bucket, and a productivity bucket. Infrastructure, obviously the first name that comes to mind with that big purple line going up would be NVIDIA, right? And some of the chip companies. But what you're looking at with that outperformance, I should note, versus the equal weight S&P 500, so that's what we're comparing these 3 groups to, is also, you kind of have the hyperscalers in there as well. I mean, Shauna, the quote that you just said from Alphabet executives, they're talking about AI infrastructure, right? So I think you can put probably Alphabet, Microsoft also in that group a little bit. And the looming question here is, okay, they're piling billions into AI spending. What does that mean and for who? And I don't think the market has really answered that question yet. And it seems like we're starting to get to the point where that question is becoming a little bit more pressing as we get further and further into this discussion. Some of the biggest companies in the US are spending billions and billions on AI. What does Alphabet building AI into systems that we use in our computers every day actually mean for the workforce, and who's going to benefit? When you look at that chart from Goldman, the market hasn't really placed its bets there yet. Enabled revenue companies that could see increased revenue, aren't outperforming the S&P 500. Companies that could maybe benefit from just straight up productivity, just AI helping their workers be more productive, those stocks aren't really up yet. And this brings us to our second chart that we have, which is a chart from BlackRock, just talking about productivity. This is the looming question right now, is what does the light blue bar look like for the AI boom? We can see what happened in the 1970s to the 2010s with that tech infrastructure boom, and I think we can all know what computers did for us and how that added to GDP, right? I don't think that's a hard one to get to. But what does AI actually do? It doesn't seem like we really have that answer at this point.
And does it lead to an increase in productivity? And it feels like that is the big question, particularly even when you just look at Alphabet, for example, right? That $1 billion beat, I guess, in what was anticipated for capex on AI. Is that going to be proven out moving forward?
Yeah, is it going to be proven out? And then what does it mean for people that actually use the product, right? Because I also think that tells you something about Alphabet's investment being proven out. If companies find good use cases for this, and I'll use Microsoft as an example because plenty of people use Microsoft Office every day, right? And they're integrating OpenAI aspects into their product, right? If that is actually useful to companies, then they're going to keep coming back and paying up for it. So then it's useful for Microsoft too. And that in turn would probably help profits in the long run.
And what's been so interesting to me surrounding this AI discussion is just the timeline of it all, right? When we talk about productivity or what ultimately this is going to mean, where all these billions of dollars of investments are going, to me there seems to be such a discrepancy or a huge debate out there about what that timeline looks like in order for it to pay off. And obviously that then begs the question, and Maddie, you brought this up before, just how patient investors are going to be in terms of how long they are willing to wait for some of these companies to then prove that their AI investments are paying off and show the investors to what degree they are.
Well, I'll go back to that BlackRock chart for one more time there with what you just pointed out. The timelines that we're showing in that chart for when it eventually contributes to GDP, that's 1970 to 2010. Right. That's a long time period. So I don't think we're going to see an increase to GDP necessarily next year, right? It's going to be a long run, and it's going to be a long time, I think, before we really have the answer to that question.
That's a great point. All right, Josh, check it out. Chart book on yahoofinance.com. More than 30 charts. You don't want to miss it.
All right, we are going to have all of your markets action ahead right here on Yahoo Finance, so stay tuned. You're watching Catalysts. Alphabet shares falling after YouTube ad revenue missed estimates. We've heard from several experts today on this, including Nancy Tangler. We asked about whether the YouTube ad revenue miss or the AI capex growth would be the bigger determinant of other big tech earnings to come. Here's what she had to say.
We're not buying Google, for example, or Alphabet for advertising. We're buying it for the cloud business and the generative AI opportunities. I do think that that's the new hot button that analysts are going to be focused on, because what you're hearing, the counter argument to mine, which is AI use cases are increasing, exploding really, is that this is a mania and there was too much spend. I was managing money in the 1990s. This is not the internet bubble. This is the beginning, early days of a transformative technology.
So there you have it. This is not the internet bubble. That is one of the key questions that's been coming up. If this AI rally and the rally that's relying on just a handful of stocks, is it going to continue, or will there be a moment similar to what we saw in the early 2000s where that bubble starts to burst? Nancy throwing cold water on that idea, Shauna, and saying that that is not the case.
Yeah, certainly. And we will wait and see whether or not that is the case, because I think that's what many analysts, many investors are asking themselves heading into this earnings season, especially once we hear from some of the other tech giants, whether or not this is the start of a bigger theme, and then also what the tolerance looks like out there from the street for it.
That's a great point. All right, well, coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Alexandra Canal is going to have you right here for the next hour, so stay tuned. Welcome to Wealth. I'm Alexandra Canal, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, Tesla is out with second quarter earnings, and Wall Street isn't thrilled with the results. We'll talk to one investor who is bullish on the stock and thinks you should buy. And tech support. Yahoo Finance's own tech editor, Dan Halley, will tell you how to protect your privacy by turning off cookies on Google's Chrome. He'll also give us a review of a laptop using Qualcomm's AI chip and tell you if it's worth a purchase. Plus, we're joined by an expert who can tell you how to avoid a critical mistake Americans make with their retirement accounts that's costing billions of dollars. Our top story today, shares of Tesla are falling after the company reported mixed earnings for the second quarter. Tesla made less money per share and missed analyst expectations. Tesla CEO Elon Musk was forced to address questions surrounding the slowdown in EV sales and the delay of its robotaxi debut. Shares are off more than 10% since the start of the year, but our next guest still thinks the stock is a buy. Here with more is Simon Hale, portfolio manager and senior wealth advisor at Wellington Altus Private Wealth. Simon, Tesla is one of your largest holdings, and you are bullish on the long-term outlook of this company, but we are seeing those disappointing earnings drag the stock lower today. Were there any bright spots for you in this report, and did the low energy and more subdued demeanor of Elon Musk on the call concern you at all?
I thought it was a great call. I walked away with no disappointments. Elon Musk and company, they've laid out on this call, they were quite clear, and they laid out a plan to get back to 50% earnings growth by 2025. And sort of, you can do some back of the math calculations, but they're talking about FSD being approved by regulators in Europe and China. That could bring an extra $1 billion to $2 billion next year. We're looking at Cybertruck ramp, possibly 200,000 units next year. There's another $2 to $3 billion in profits. But then you look at energy, and Tesla Energy is going bananas. I don't know if you've looked at the charts or the deck that Tesla put out for this quarter, but there's just this bar line going straight up with Tesla Energy, and they did almost $900 million in profits. Just this quarter, deploying almost 10 gigawatt hours, and that if you can duplicate that next year, there's another $4 billion. So, if you just put this in perspective, trailing 12-month earnings were around $12 billion, and on their existing footprint, they've laid out a plan for over the next 12 months to be able to grow that by $8 billion. That's 50% growth going forward. And I think that Musk and company have laid out the groundwork to move this train back to a 50% growth rate to the end of the decade. And the train's starting to leave the station. So we're quite excited.
But Simon, what would you say to critics who do not trust Elon Musk as a leader? We've already seen the delay of that robotaxi rollout. He's talked about cheaper EV models coming to market, but even that hasn't come to fruition yet.
Yeah, I think Elon's extremely optimistic, but I don't think there's a leader that can push his employees more than Elon does. So, whether it's 8.8 or 10.10 with the robotaxi event, I don't think that's going to matter. All of these short-term headwinds are just nothing burgers when you look to the end of the decade. We're looking at a deca-trillion-dollar opportunity here. And to overlook that this early in their growth stage, I think investors would be disappointed if they didn't own a piece of Tesla in their portfolio. And in terms of the new low-cost vehicle, again, all of these are completely new products that have never been done before. So the Cybertruck was late getting out, but it's a fabulous product. And I think I've seen it in a million rap videos, and every star in Hollywood wants to drive this today. So that thing's doing extremely well. And if we look at their Tesla Energy, it's kind of boring, but the demand for this is quasi-infinite. And Elon talked last night about how Tesla Energy, the Shanghai factory that they're building, could be 2 to 3 times as large as their US production. So that alone, just think about this for a second, Alex. In the last 12 months, Tesla earned roughly $16 billion in profits. And if they're able to ramp up these megapack factories at the rate in which they're currently going, they could do $16 billion in profits just in their energy by 2027. I mean, that's bonkers. So we see a lot of great things for Tesla going forward. And what's really interesting is when we're looking at their battery packs or their Tesla Energy, is they basically built out a model, and they thought about this a long time ago, that whatever excess battery capacity that they can receive from other manufacturers, if they don't need it in their autos, they're going to put it in the mega packs. So right now, as the legacy automakers are pulling back on their demand or their orders for EV batteries, Tesla is picking them up at pennies on the dollar, putting them into these mega packs and selling them at a 30% plus profit margin, which I think is absolutely brilliant. And what it's doing, it's smoothing out the earnings for an their auto earnings. It's smoothing out their auto earnings through a period of high interest rates and a slower economy. So it's really brilliant what Elon's been able to do.
So you're clearly bullish on the long-term outlook. If you're not an investor today, should you get into it right now at the levels that we're seeing?
Absolutely. Absolutely. I think that this is a fantastic entry point. I look at it as almost a gift, seeing the stock price being down here around $217 today. We'll probably look back on this similar to if you look back on Apple in 2011 and split adjusted, it was trading around $20. Everyone wishes they had the insight or the foresight to be buying Apple at a time. And people were criticized. We were criticized for buying Apple in 2011. Our clients are not upset today for that decision. So I think this is going to be very similar. What's happening right now is we're having a convergence of multiple technologies that Tesla's involved in, and you're talking AI, you're talking the cost of batteries, the cost of chips coming down, and you have a company that's taking all of these cost savings and driving them into their new technologies, and then implementing AI, where all of these cars will and are effectively robots on wheels. It's pretty exciting. I'm actually thinking about the movie Knight Rider 40 years ago, how we had talking cars, and I thought that was pretty ridiculous. And I think we're not too far off where we'll have cars. I'm predicting robotaxis by 2027 with an AI-generated voice command, which is going to be pretty neat.
All right, we'll see if flying cars are in our future. Tesla shares, though, off about 12% currently. Simon Hale, portfolio manager and senior wealth advisor at Wellington Altus Private Wealth. Thanks for joining us.
Thanks for having me, Alex.
Well, potential home buyers are pulling back from the new home market. Sales of new homes in June hit a 7th-month low as high mortgage rates and prices weigh on buyers. Here to break down the report, Yahoo Finance's very own Danny Romero. And Danny, it looks like the housing market is still struggling, at least based on this data.
Allie, some buyers are turning away from the new home market. Government data out this morning shows that sales of new homes fell 0.6% to 617,000 annual pace in June, and that fell short from economists' expectations for a 640,000 figure. So what does this mean? It really just showcases the ongoing challenges of higher mortgage rates, high home prices, really impacting buyer appetite. Another thing, a key highlight from this report was the inventory. Last month, the supply of new homes increased 0.8% at the end of July. Now, if we compare that to a year ago, the supply of new homes has increased 11.2%. So that really is signaling that the rising building costs, higher interest rates, and even the inventory challenges are really harpening and dampening the industry outlook and the industry as a whole. Allie?
And Danny, can you tell us more about rising housing supply in certain regions and how that's impacting potential home buyers?
Allie, it's all about the South, especially Texas and Florida. Those were the hottest housing markets during the pandemic, but the tide has turned there. And we actually heard from Pulte Group's CEO, Ryan Marshall. He even talked about the rising inventory in the Southwest Florida area that's impacting them as well, not only for resale, but also for new homes. And one of the main factors for this slowdown, specifically in these regions and Florida, is the rising insurance premiums that homeowners have to pay in order to protect their home from extreme weather conditions. And just to give you some perspective, the average annual premium in Florida is about $6,000. That is the highest across the country, according to the Insurance Information Institute. So really, we've also seen there's other data out there that's really showcasing that some buyers are even canceling the deal in Florida, whether or not to buy a home. So really, this is an ongoing challenge right now, Allie.
All right, we'll see if there's any recovery ahead. Danny Romero, thank you so much. All of your markets action ahead. Stay tuned. You're watching Yahoo Finance. Over the last month, we've seen small cap stocks outperform big tech, with the Russell 2000 up over 10%, while the Nasdaq is up just a little over 1%. Joining me now to discuss how investors should play the current market is Lee Munson, Portfolio Wealth Advisors President and Chief Investment Officer. Lee, you are all about that small cap trade. It's your second largest equity position. What would you tell the skeptics who think this rally in small caps won't last? Because I believe you did tell our very own Jared Blickery a few weeks ago that you had some serious concerns for the smaller companies.
Oh my gosh, 2 weeks ago, I was just complaining to Jared how small caps are the bane of my existence. I'm all overloaded on them. Why didn't I go to medical school or just do something else in my life? I am my own tell. You heard it here first. I was maximum frustrated. And the funny thing is, that week was where this all started. And we've had this massive run up in small cap. We haven't seen it since whenever. And I think what's happening is that there's two things that's happening. And by the way, it's okay to complain. It's okay to be frustrated. But what I wasn't doing when I was talking with Jared a few weeks ago is I wasn't selling those positions. The idea is that small caps generally do well at the beginning of an expansionary cycle. They don't do well in late cycle. And I think what people have to remember is that we have this presumption that we're going to start slowing down. We have this presumption that the Fed's going to have to cut rates. Why are they going to have to cut rates? Because we don't want to cause a recession. So the market's looking 6 to 12 months out from today, and it's saying there's going to be some sort of slowdown, which the Fed is going to start cutting in September. I think it's going to be November. Nobody cares. It doesn't matter if it's September or November. And so people are starting to load up on what they think is going to be this huge expansion going into next year. And the election and the presidential candidates have a lot to do with that, right? But I also think there's another story here. And the story is the marginal buyer for the Mag 7 and artificial intelligence. People are starting to get the message that while I love ChatGPT, I'm on every single moment of my life, but it's going to take time to really make the killer app, the thing that's going to cause Apple to have to sell a whole new line of stuff, that's going to cause Microsoft to have this whole new software to sell people, and that it's not going to happen in the next 6 months. And so people are starting looking at profitability, they're starting to question it, and honestly, it's not that people are just out there selling all their Mag 7 stocks, it's really a matter of, why do I want to do this right now? Let's see where the use is. Let's see that thing that will get everybody into the AI trade. And, that's not happening right now.
So given that, Lee, how long will we see this market rotation out of big tech? And how could the next round of earnings really impact that trade as well? Because we've already seen some big tech earnings start to trickle in, and they were pretty much a disappointment.
They were. And I think that what's going to happen between now and the end of the year, Google was fine, everything's, these big firms, they're cash cows. But they're not telling people what they want to hear. They want red meat, they want blood. They want these big tech CEOs to say, we're getting a return on all the money that we spent shoving down the earnings of NVIDIA. All this money we've been building out, the data centers, the chips, at great expense, these mega scalers like Microsoft and Facebook, they want to hear these CEOs say, we're getting a return on our invested capital. And that is not what they're going to hear between now and the end of the year. So it's not about a sell-off. Certainly the prices are dropping. I think it's more of a buyer strike. And in the meantime, look at the valuations of small cap. And also look at the extreme valuations in small cap value where I like to hang out, for half of my portfolio. Small cap value, they've been earning all year, right? They've been sort of flat. I mean, as I was talking with Jared a couple of weeks ago, we're talking, at the time it was like 700 days since the Russell 2000 had made a new high. And so I think there's a rotation going on because if you look at just the raw valuations, you're getting a big bang for your earnings buck. And until I see valuations that claw, the valuations from the Nasdaq to small cap, until that gets more normalized, you're going to continue to see small cap outperform. I don't think this is just a 1 month deal. Usually it's going to be 2 to 4 months. I think we're a month and a half into it. I think this could continue all the way to the end of the year. Because really, what are the CEOs of these big companies going to say? We're making bank on AI? Not going to happen.
And Lee, you mentioned that you do expect the Fed to cut rates at some point this year. Besides small caps, what other areas of the market do you think will benefit from that expected easing cycle?
It doesn't. I think large value is going to benefit. Banks are going to benefit. I think a Trump presidency, people think that's going to benefit. I think you've got energy that could benefit as well. But I think the thing is that when you're really looking at it, getting these rates lower is going to help all the other stocks that are not Mag 7. Your banks, your tanks, things that are economically cyclical, things that have to do with the real economy, places that actually make real stuff. That's what's going to benefit. Because remember, all these small companies, especially in energy, healthcare, financial, all that stuff, they have a lot of floating rate debt and they don't have a lot of fixed debt. I mean, does Apple really need to borrow money? Does Microsoft really need to borrow money? And so I think any company that you look at their balance sheet and they have a bunch of floating rate debt, those are the companies that are going to magically have their earnings increase just because their debt load is going to go down. It's really simple. I mean, it's just math.
All right, a lot to look out for over the next year. Lee Munson, Portfolio Wealth Advisors President and Chief Investment Officer, thank you so much for your insights.
Thank you.
Google is backtracking on its pledge to get rid of third-party cookies on its web browser Chrome. For more, we bring in our very own Dan Howley for this week's edition of Tech Support. So Dan, Google and cookies, what's going on here?
They are not delicious cookies either. Tate's, by the way. Man,
oh yeah, they're
smoke
the best.
everything else, wild. All right, so these cookies, these are basically third-party tracking cookies. They're something that are used to be built into basically every web browser, and it allows one website to plug a cookie into your browser or into your computer and then track you across the web. So, for instance, if you're looking up, say, buying a new computer, you'll start seeing computer ads when you go to different websites. It's the kind of thing where, people always say, oh, my phone's listening to me. It's not. It's just that you go to websites or different behaviors that you have show up on other websites that you might visit. And so Google was originally going to get rid of this in the name of privacy. Advertisers freaked out. It's been an ongoing issue, and now Google's pulling back on that. They're saying what you're going to be able to do now is disable third-party tracking cookies. They haven't said exactly how yet, but eventually you'll be able to do that. Some of the things to look at here are that other browsers, like Safari, Apple's browser, Firefox, they don't have third-party tracking cookies at all. So it's not like those are following you around. They're just not there. Chrome and Microsoft's Edge, which is built on the underlying software that powers Chrome, both have that. You can turn them off or turn them down in Microsoft's Edge. And now apparently you're going to be able to do it in Chrome. And it's, again, all about privacy. Part of it is the ads will be more relevant to what you have or what you're looking for. The reality is most people just don't want to be tracked online. And it's kind of creepy when you're looking for, a spark plug, and spark plug ads start showing up in every website that you go to.
Yeah, the big brother of the internet.
Yeah.
But moving on from software to hardware, you recently purchased a laptop that has AI capabilities. So what do you think so far? And is it worth it right now?
Yeah, so this is the Microsoft Surface laptop that I have here. The big deal about this is, Microsoft's had Surface laptops for some time. The main to-do is what's inside. It's a Qualcomm chip. The reason why that's important is because Qualcomm is known for mobile chips primarily. They've dipped their toes into the Microsoft space a bit. Not the best results, but this is actually an impressive device. The reason why is because it kind of takes the best of mobile and computing and combines them. So you're going to get very good battery life out of this. You're going to get solid performance. That's something that's been missing on Intel-based laptops from Intel-based Windows laptops for some time. Ditto AMD. You look at what Apple's been doing on the Mac, and my God, I don't even need to remember a charger anymore. It's just that good. And so that's what this is doing for Microsoft and Windows PCs. The other thing is it does have some AI feature capabilities. It's part of this Copilot Plus PC that Microsoft is pushing. Not really that big of a deal yet. I think it's still very early in that kind of space. I'm not going to go out and buy a PC because it has AI capabilities. I'm going to buy it because I want to play games. This is not going to do that, but it is going to be good for work, and I think that's very important. One of the other things to point out is because it's running a Qualcomm chip, there are some apps that need to be emulated. Basically, a piece of software has to interface with it for it to run on Windows, so you might get some performance hiccups with those apps, but overall, I found this to be a great device. I was using it as my primary driver for work for a while. And honestly, if I had to go out and buy something right now, this would be the Windows laptop that I would get. Plus, it's very pretty. Look at how blue it is.
Yeah, I'm in the market for any laptops.
It's awesome. It is very good. Yeah, I dig this a lot.
Awesome. Well, thank you so much for your insight there, Dan. All things tech. Appreciate it. Shares of LVMH falling after second quarter sales came in below estimates, driving fears that the company is falling victim to a broader slowdown in the luxury goods market. That followed a surge in demand in the aftermath of the pandemic. Sales for the second quarter were just shy of 21 billion euros, which is around 22.7 billion US dollars. Analysts had expected sales of more than 23 billion in US dollars. Despite the miss, the figure represents a more than 1% rise in organic growth from the year prior. Taking a deeper look into the different segments, selective retailing, perfumes and cosmetics, along with fashion and leather goods, all posted gains from the year prior, while wines and spirits, watches and jewelry both declined. The company did announce an interim dividend to be paid to shareholders in December. LVMH did acknowledge the, quote, uncertain geopolitical and economic environment and said they remain confident that they will maintain a strategy focused on enhancing its brands and drawing on the quality of its products. Well, spot Ether ETFs making their debut this week. We take a look at how the ETFs are moving and if they're worth adding to your portfolio. That's right after the break. Spot Ether ETFs moving to the downside in their second day of trading. The ETF saw over $1 billion in volume during their first trading day. To put that into context, spot Bitcoin ETFs pulled in $4.5 billion in volume during that same time period. Joining me now to discuss what's next is ETF expert Dave Nadig as part of the ETF report brought to you by Invesco QQQ. Dave, like we were just saying, we saw a very successful rollout of the spot Bitcoin ETFs earlier this year, but the debut of the Ether ETFs is definitely more muted. So do you expect those inflows to pick up over time?
Well, I think it's okay to think about Bitcoin and ETH as sort of being two sides of the same crypto investor coin. I think Bitcoin is always going to have that position as digital gold, and I think it's going to be the primary asset most non-crypto native investors look to when they're looking for a little crypto exposure. I think the smart move for most investors is to think about diversifying across the available crypto assets. So what I'm hearing from a lot of folks is that the kind of trade-off we're seeing right now, where the ETH products are about 10 to 20% of what we're seeing in the Bitcoin products, that's actually a pretty reasonable diversification strategy. Putting, say, $500 in the Bitcoin space and maybe $100 or $200 in the ETH space, that really does give you access to two very, very different parts of the crypto market. So I think what we've seen on day one is probably pretty similar to what we're going to see over the course of this year. Right now, we're sitting at about $60 billion in the Bitcoin ETF complex, about $10 billion after yesterday in the ETH complex, largely because Grayscale mapped over their big closed fund into a new ETF. That ratio of maybe 60 to 10, 50 to 10, that feels like the right ratio.
And what about the price action that we saw in Ether? Because after those ETFs debuted for Bitcoin, we saw Bitcoin really skyrocket, but we didn't see that same price action for Ether. So why was that? And do you expect the price to tick up over time?
Well, I think there's a bit of a sell the news here, right? After the incredible success of those early Bitcoin ETFs, everybody was looking at these ETH ETFs as the next shoe to drop. There was a lot of price action in Ether running up into this launch. There was a lot of speculation really up until a few weeks ago about whether we would see these now or sometime between now and the end of the year, or even not until next year. So there was still a lot of uncertainty here. Now that they're here, I think it's not unreasonable to think that some folks are selling the news. So we have seen ETH take it on the chin a little bit. We've seen Bitcoin take it on the chin a little bit too. So we haven't seen that kind of new money flowing in. I think it's worth pointing out that yesterday, the launch day for these products, while we had $107-ish million show up in the new ETFs, we had about $87 million come out of the Bitcoin ETF. So it's, is that money selling Bitcoin to buy ETH? I think there's a reasonable chance that's true.
And what's the benefit of selecting a spot Ether ETF or a spot Bitcoin ETF versus just buying these cryptocurrencies outright?
Well, if you can buy ETH native on the blockchain, if you have, say, a Coinbase account or someplace where you're doing on-exchange ownership of crypto, honestly, there are some advantages to doing that. Obviously, if you're concerned about who has your keys and those types of things, having your own allocation is important. But notably, the ETH ETFs can't do what's called staking. The way the Ethereum network works is that owning the ETH is what you use to validate the new transactions coming in on that blockchain. The ETH that's in these ETFs cannot do that. That's an SEC rule for the approval of these products. So right now we have about $10 billion sitting in ETH that can't be used to validate the network. It can't be used to do work. There's a yield associated with staking that asset. It's about 5-6% right now. You're forgoing that in an ETF version. I think that will change over time, but for the moment, you're not getting the yield you would get if you were a long-term buy and holder of ETH on chain.
And we talk a lot about being diversified in the stock market, and you alluded to this in your first answer, but can that same method be applied in the crypto world? So in other words, is it not enough to just have exposure to Bitcoin? Do you really want to be diversified among all the different cryptos?
I really think you do, unless you're only looking at Bitcoin as that digital gold and you're just super skeptical about the entire rest of the crypto industry. I think it makes sense to be diversified, frankly, beyond what we can get in the ETF. I think that's what we're headed for. We have Bitcoin as digital gold. We have Ethereum as basically buying time on the world's largest supercomputer. There are also all of these other very interesting projects going on in crypto that you can't get access to in an ETF right now, whether that's, people doing real world assets or real world treasuries, whether it's folks taking, NFTs online, all sorts of things we can't get access to yet. ETH and Bitcoin are sort of the beginning. I think a diversified play across those two makes the most sense. And as hopefully we get more and more products, more and more of these altcoins coming online in ETF format, I think you'll see diversified index-based approaches. I think that's going to make a lot of sense.
Dave Nadig, ETF expert, thank you so much for your insights.
Thanks for having me.
Coming up, the economy is front and center in this year's presidential election. We'll get Nobel Prize-winning economist Paul Krugman's take on where things stand when we come back. Tesla's latest lackluster earnings report, which has caused the company's stock to tumble this morning, is bringing a new spotlight on the leadership of CEO Elon Musk, who oversaw the tech and auto company's profit fall 45% in the second quarter. With Musk embracing GOP politics that seemingly do not align with electric vehicle company goals, what does the future hold for the world's richest man? For more, we welcome in Nobel Prize-winning economist and New York Times columnist Paul Krugman, who has written on Musk, the economy, the election, and so much more. Paul, welcome to the show. So much to discuss with you today. But let's start on Musk, because you wrote in 2022, quote, "Given what we've seen of Musk's behavior, I wouldn't trust him to feed my cat, let alone run a major corporation." Two questions for you there. One, has your opinion of Musk changed since that time? And two, just zooming out, what has made him such an alluring figure to begin with?
Okay, no, my opinion has changed in that it's a little bit worse. I mean, he's confirmed all the worst expectations. I mean, he's well along that sort of conveyor belt from, conservatism, I like my taxes low, to full on QAnon type conspiracy theorist. So it's an amazing thing to watch someone who could, afford to finance a personal intelligence operation comparable to that of a medium-sized country, instead buy into random bots tweeting conspiracy theories on his site. So that's really bad. Yeah, I mean, what can we say? It's pretty amazing to see him going this far off the edge, and fundamentally, the MAGA movement is hostile to what he made his name on. I mean, he was whatever the allocation of credit, Musk pioneered electric vehicles in the United States, which is a big deal. He did some stuff on space technology that is a big deal. So a lot of people really wanted to admire him. The trouble is he's not behaving now like someone you can trust on anything.
Mm-hmm. And outside of just Tesla, he's also made headlines around the election. It's clear from his post on X that he approves of Donald Trump and that he supports Donald Trump as the next president. But it's interesting because Trump already said he would be rolling back some of those EV policies that Biden has put in place. So what do you think the play here is for Elon Musk, and what's behind his support of Trump?
Well, yeah, I mean, what you watch, I've spent quite a while, and other people even more, trying to think about the psychology in general of tech billionaires. It's a very peculiar set of politics. It's not like, if you look at sort of major Fortune 500 companies, their CEOs basically are trying to maximize profits for the shareholders, which is itself that's a question whether that's a great thing or not. But when you talk about people who are individually enormously wealthy and made it to some extent by being contrarian and so on, they aren't all that rational in their political beliefs. Remember, a lot of people, to some extent Musk included, went gaga over RFK Jr., who is clearly a crank. And now I think this really is about Musk's personal hangups. A Trump administration would be really bad for Tesla's core business.
And Musk, it's interesting because he's not the only tech CEO to voice support for Trump. What role do you think Silicon Valley will have on the outcome of this election? And how will crypto factor into that support as well, given the Trump Vance ticket is very pro-crypto, and we've seen entrepreneurs like Mark Cuban, for example, theorize about this?
Well, crypto is certainly, there's a lot of money involved. But at least what I understand from the political scientist types is that there are diminishing returns to money. Money matters. A campaign that doesn't have enough money to put a lot of stuff on the airwaves to run an organization is in trouble. And just before Joe Biden stepped aside, it looked as if the Democrats might have a real cash problem. But with this huge outpouring since Harris became the presumptive nominee, that's not going to be an issue. So we're at the point now where at the margin, billionaires don't matter, which must be intensely frustrating to them, of course. So I don't think that makes a big difference. Crypto, yeah, I mean, it is a funny thing how crypto has become a big player in political donations, which in a way they have to be, because they're an industry that hasn't got, still doesn't have a use case except for money laundering. So it's all speculative stuff, and it's So getting sympathetic politicians is pretty much all they got.
So billionaires don't matter, but it seems like the low-income voter, that's going to matter in this election, especially given where we're at with this economy. So what does the Harris campaign have to say? What does the Trump campaign have to say to really start appealing to this cohort of voters?
Well, I mean, that's the thing is, it's not a homogeneous group. When we say low-income voters, what do we mean? Do we mean small town whites? Do we mean big city blacks? Do we mean altogether? It's just not the idea that there's some simple formula. Trump offers a lot of cultural stuff, a validation, maybe. To some people, although he's got to hope that people don't actually read J.D. Vance's book, which is actually quite contemptuous of the people he grew up with. But on the other hand, Harris now, it's a really, this is certainly a transformative moment now. And let's remember that turnout among non-white voters, turnout among women is going to matter enormously. Some of the polling I saw said that actually before they stepped aside, Biden was polling about as well with whites as he did in 2020, but it was losing ground among non-white voters, and Harris might make a difference. Who knows? But it's certainly not the same game it was at all.
Not the same game, and the game is potentially going to be changing on the Fed side as well, because likely ahead of the election, we will see a Fed rate cut. At least that's what markets are predicting. If the Fed cuts rates this month, in September, November, what impact will that have on prices, consumer sentiment, and really that lead up to the election?
It shouldn't matter much because there are, as Milton Friedman famously said, long and variable lags. What the Fed does today shouldn't affect the real economy for quite a few months, not till well after the election. But consumer sentiment might be affected. The narrative might change. I think one of the things that we've learned in the past couple of years is that consumer perceptions of the economy don't very closely follow the traditional variables. By the normal standards with low inflation, we're about to get some new inflation numbers in the next couple of days that will probably validate the idea that basically inflation is beaten. Unemployment is still fairly low. Nothing's going to change on that front. But the Fed, if it cuts, that's kind of a prestigious voice saying that we're not worried about inflation anymore, which might affect things. And just in general, I mean, there are some very early hints, if you look at, like the Goldman Twitter Economic Sentiment Index, that economic sentiment has suddenly rolled over in a positive direction. And we don't know that for sure. We'll see. But concretely, I mean, if you ask what impact will what the Fed does have on the unemployment rate on election day, the answer is, margin of error, nothing there. If we ask what effect might it have on how people feel about the economy, it might make a big difference.
Yeah, and speaking of the Fed, Trump has said that he will keep Powell as Fed chair if he were to win. Let's say that happens. What role will Powell have within a Trump administration? And considering Trump's tariffs will likely contribute to higher inflation, how much more pressure will that put on the Fed?
Well, it's an interesting thing. I mean, the overwhelming consensus among professional forecasters, and I'm not, that Trump's policy proposals are pretty seriously inflationary, that a Trump administration would be much more inflation prone than what we've been seeing under Biden. And the Fed, in its normal role, would try to lean against that, would probably, put off rate cuts, maybe even push rates back up again. We already know that Trump and people around him basically don't believe in Fed independence. So whatever Trump may say now about he's going to keep Powell, the idea that they would leave the Fed free to raise rates if inflation picks up during a second Trump administration is fantasy. They would, in fact, be leaning very hard on the Fed. In fact, if the Fed does cut rates, either this month or more likely next month, we're going to get a lot of claims. We're already seeing some pressure saying, don't do that. That's a political move to help Democrats, even though it's actually basically responding to the economic data. But we're going to see, regardless of who is actually Fed chair, we're going to be seeing a lot of politicization of monetary policy. Democrats and to some extent even Trump, and no, not even right, but for the past couple of decades, presidents have been very careful, for the most part, to avoid making the Fed appear to be a political football. But those rules don't apply to a future Trump administration.
Yeah, a lot of rules don't seem to apply in this election cycle. But Paul Krugman, Nobel Prize-winning economist and New York Times columnist, thank you so much for joining us and sharing your insights with us.
Oh, thank you.
Coming up, there's a critical mistake Americans are making with their retirement accounts. We'll tell you how to avoid that costly mistake next. It's time to get retirement ready. You could be missing out on substantial investment gains, and guess what? You may not even realize it. Workers who pull their retirement savings out of the stock market when switching jobs are at risk of losing millions of dollars. According to a new Vanguard study, 28% of workers who rolled over their Vanguard IRA form from a 401k left funds uninvested for at least 7 years. Here to discuss how investors can avoid this mistake is Ed Murphy, Empower Chief Executive Officer. So Ed, how often do you see this mistake and what can people do to avoid it?
Well, I think unfortunately it happens more often than it should. There's a couple things that you can do to avoid it. One is you can stay in the plan. So when you change jobs or retire, you don't necessarily have to take the money out and roll it to an IRA. Oftentimes it's better to leave it in the plan and get the benefit of better pricing, oftentimes a different product set or diversified product set that you can take advantage of. But to the extent that people do want to roll it over, it's really important that you consult with an advisor so that when you do roll it to another institution and you roll it into an IRA, the money doesn't sit there. It actually gets put to work based on what your investment objectives are.
Got it. And looking more broadly across the retirement space, you say that the future of retirement looks bright. And I think some might take that view, that contrarian viewpoint, and say, well, inflation's high, prices are high. Why are you so optimistic?
Well, if you think about it today, we have 115 million Americans that are in the workplace system. And between what they have in defined contribution and IRA accounts, they've saved $24 trillion. And many people are saving at a rate of about 8%. But not everybody's in the system. So it's a work in progress for sure. And what we're focused on at Empower is trying to get more Americans enrolled in the system. Because what we know is if you don't have access to workplace savings through payroll deduction, you just don't save. And so there's a big movement to try to get more of these small companies, typically 50 employees and less, to offer retirement plans to their employees.
So let's say you don't have a retirement plan through an employer. What steps could you take now to start saving?
Well, you can save outside the plan, obviously. So you can set up an IRA account. Oftentimes, people will set up an emergency savings account so that if there's an unexpected event, they have the money available to cover those costs. But the most important thing to do if you want to save on an after-tax basis or pre-tax is to set up an IRA account.
And for those that do have access to an employer fund, are there particular things that they should be doing? And I always have the question of, should I be putting more in than the match for my employer?
Well, I think it depends. Everybody's situation is different. You certainly should at least contribute up to the match. And if you have enough discretionary dollars to save beyond that, you're best served by doing that. And I think in terms of the options, oftentimes what we see is 70% or so of the individuals are putting the money into the default investment, which is typically a diversified target date fund, sort of a set it and forget it kind of mentality, which I think works for most people. The main thing is to continue to invest. And oftentimes, auto escalation is a really good feature where every year the contribution percentage will go up 1%. So you may not start at 10%, you start at 5% and you work your way up to 10%.
And what's the biggest misconception or myth that you hear about early stage retirement planning?
I would say that people aren't saving enough is a little bit of a myth, just based on the numbers that we see. We have 19 million Americans as customers, and so what we're seeing is they are saving at a rate of about 8%. What we need to do is to get more people in the system. I think that's the most important thing we could do.
And something that we saw just this week is the debut of spot Ethereum ETFs. And I'm curious, if you are a younger investor, should you be more risk on with your 401k if crypto is available to you? Is that something that you should lean into?
Well, I personally wouldn't be a proponent of crypto inside a qualified plan. I think that you can take a longer term view and you can take a little bit more risk, because if you're a younger person, you're not likely to tap into those dollars until 20, 30 years down the road. That being said, I think there are better investments, more of a diversified equity portfolio that make more sense perhaps than crypto.
All right. Ed Murphy, Empower Chief Executive Officer, thank you so much for joining us today.
Thank you, Ellie. My pleasure.
Awesome. Let's do a final check of the markets here. We're seeing red across the board, with the Nasdaq leading the way lower, down more than 2.5% right now. That's followed by the S&P 500, which is down about 1.5%. The Dow is shed 345 points, and this is midway through the trading day. Of course, this comes after we saw disappointing earnings from both Tesla and Alphabet, setting us up for the rest of those big tech earnings to come. So we'll see if we can really try and recover from these lows here. But that is it for wealth. I am Alexandra Canal. Thank you so much for watching, and stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern. You won't want to miss it.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers,
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.